There's a lot of creative destruction that's taking place in markets.
Some of these things are overdone. It's about valuation.
The stress within the AI and the software names is still very, very concentrated.
There are going to be losers and winners all over the place.
It's that unknowing that makes people much quicker to pull the trigger.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, the tech sell-off resumes. Equities adding to losses following the biggest weekly decline since November. Investors piling into bonds, sending yields down to new lows for the year, looking for somewhere to hide as AI disruption is upending the outlook. We're picking up where we left off following the long weekend.
Here's a problem that a lot of people are trying to grapple with. Is this a question of just AI fears and disruptive potential effects? Or is this recession fears, right? If you look at the utilities that are outperforming, if you look at the fact that bonds suddenly are rallying to such a big degree, this could be a representative feature of some sort of fear about growth. And yet people are looking at the specific sectors within AI, still pointing to disruption as the main driver here.
Utilities record highs. Staples all-time highs. Super defensive. Financials down every single day last week. The banks had their worst week of the year so far. Their worst week going back to April of last year. On the same week, we had a payrolls report that delivered the biggest payrolls growth we've seen in more than a year. So square that circle.
I can't square that circle. And if you want more confusion to make that a little bit more square rather than a circle, the Bank of America Fund Manager Survey came out, and the no landing expectations among the fund managers surveyed were at a record high. Fund manager optimism at the highest going back to 2021. Are they concerned that there's overinvestment? Yeah, but they're not necessarily voting in that kind of way. So in terms of recession fears, that doesn't seem to be anywhere on the table.
Lots to get into with the fund manager survey. This is one that jumped out to me. And that 57% of FMS investors expect higher long-term rates, the highest level since February 22. Just goes to show you how offside this market is right now, with yields at the lows for the year and 10s this morning down by 2 basis points to 4.0%.
Which is really a key question that a lot of people have. Is this a momentum squeeze? Is this an issue of everyone having been overweight the AI story, having been overweight the sort of short bond story, and suddenly it gets ripped on its side? I mean, is that essentially what we're seeing, or are we seeing a fundamental shift in sentiment? And I think that that's what people are parsing through. I saw a lot of notes over the weekend talking about the moats around software providers, the moats around companies to prevent them from AI disruption. There clearly is a nuanced look at what exactly we're talking about, and not necessarily throwing everything away in terms of expected disruption. That said, you're not seeing it market performance. So what gives? This is a confusing market.
Remember all those outlooks that were written in October last year and published in November, December? Everything feels pretty stale 2 months into 26, doesn't it?
It felt pretty stale about 2 weeks into 2026. I think that they've rewritten it probably about 6 times. And anyone who really comes on and says that they're not confused, well, I don't know. I'm curious to hear why.
If you're just tuning in, welcome to the program. Bond yields down across the curve, 10s down another 2, 30s as well, 30s at 4.67. Coming up this hour, we'll catch up with Russ Koesterich of BlackRock following 2 weeks of losses, Momei Qu of PSP Growth on whether the tech slide has more room to run, and Juneau of Bank of America on why the bar is high for further rate cuts. We begin this hour with stocks pulling back as traders remain cautious on tech. Russ Koesterich of BlackRock writing, we have made changes to our equity composition, moderating our tech and AI overweight, and have also moderated the size of our US overweight. Russ joins us now for more. Russ, welcome to the program. Let's take it from the top. How were you set up coming into 26? What have you changed, and why have you changed it?
Good morning, Jonathan. So coming into the year, we already made some shifts at the end of 2025. And I think most of those were in line with what everyone is referring to as the broadening out trade. We were bringing back some of our AI exposure. We were trimming our tech exposure, adding to cyclicals like industrials. And also because we were also bringing down some of the growth overweight in favor of a more balanced portfolio. If you're going to add a bit more value, have a bit less growth, one of the implications of that is you're probably going to own a bit more international and have a little less of a U.S. overweight. And that's exactly what we've been doing really since the back half of 2025.
So, Russ, many people describe this as a cyclical rotation, an improvement in cyclical appetite around the world, an improvement in so-called risk appetite. Yet, Russ, last week took on a bit of a different flavour. Lisa mentioned it, a recessionary theme starting to go into the sector price action. When you see staples at all-time highs, utilities at record highs, and the banks start to sell off. Russ, what does that tell you?
It tells me the market is confused, and I share kind of the questions around this very strange rotation. If you look at the best performing sectors year to date, you could be forgiven for kind of being a little bit uncertain about what the market's thinking. You've got industrials, energy, materials, and then, as you and Lisa pointed out, you've got staples and utilities. So that combination of we love cyclicals and we're hiding out in defensives is very unusual. Now, my own view is I don't think we're looking at a recession. As you all mentioned before I joined, the labor market report was very solid. We're seeing manufacturing rebounding. In general, most of the economic indicators are fairly solid. And if anything, some of the concerns we had about the labor market 1 or 2 months ago, maybe they're a little bit less acute today. So instead, I think what we're seeing is a change in sentiment around the tech and the AI trade. You saw it during an earnings season. Rather than applaud these $120 billion CapEx announcements from the hyperscalers, the market actually punished them. So to my mind, this rotation and this odd coupling of cyclicals and defensives, more about a change in sentiment, more about a rotation out of tech, and less about an economic view.
Russ, can you see an overall index level rally if you don't have the participation of tech?
It's hard. And I think one of the reasons you're actually seeing this massive rally in sectors that have much smaller market cap is it doesn't take a lot if you're rotating out of tech, which, depending upon how you want to define it, 35, 40% of the S&P 500, into much smaller sectors. That's a lot of money coming out, pushing some of those companies up very fast. But I do think it's a legitimate question, and this is why the U.S. market has actually been churning year to date. If we don't get some stabilization in tech, hard for the market to go higher. The good news is, for two reasons, I do believe that selectively there are names in tech you want to own right now. First of all, the valuations, particularly the mega cap tech, the Mag 7, have come down significantly. Second of all, this has not been an earnings problem. If you look at the Q4 earnings, you still saw very strong leadership, 25, 26% year-over-year growth in tech, much higher than the rest of the market. Again, I think this is more about sentiment than the fundamentals.
Russ, you said that the market is confused. We're certainly confused. This is a confusing moment. I wonder how much that confusion is why people are selling U.S. equities and U.S. markets more broadly, because the confusion is really rooted in the United States at pretty high valuations. Is that part of what's behind, I don't want to call it the sell America trade, but the diversify away from America trade?
There is a little bit of that. And certainly, again, as I said in the beginning, if you're more skeptical on tech, if you're more skeptical on AI, you've got a much higher concentration of those companies in the U.S. than you do in other parts of the world. So it does make sense you're going to see this shift in relative performance. But I do think there are a couple of other things going on as well. One, if you want to own cyclicals, if you want to own more value, we actually find that while the growth opportunities in the U.S. are generally the best in the world, often we find better value opportunities outside of the U.S. And the second argument is that there actually is or are a few fundamental catalysts that would suggest increasing your weight to other parts of the world, particularly in Asia. When you see what's been happening in Japan, the clarity after the election, the likelihood of more fiscal stimulus, the semiconductor rallies that are supporting markets in Korea and Taiwan, some of the rotations out of the U.S., I think they do make sense.
So, Russ, let's talk about something else that might be confusing for people. When they hear investors come on this program and talk about investing in more cyclical parts of the economy, more cyclical parts of the global equity market, and then they see bond yields dropping at the long end of the curve with 10-year yields at the lows of the year. Russ, they're confused by that as well. Just what is behind the move in the long end?
It is a confusing market. Now, I do think you've had a couple of data points that have helped support the rally. Most notably, the CPI print was very benign, and that has helped. We've also seen actually some modest improvement on the fiscal side. Now, there's a very fair debate about whether or not that's going to last. And I think that in the long term, I would be a little bit cautious about this rally in the 10-year, particularly as we get down to 4%. But, to go back to the original question, why have people been loading up on cyclicals? Most of the economic indicators, not just in the U.S., but globally, have actually been signaling that you're going to get a decent start to the year. And with that benefit of more operating leverage for cyclical companies, I think there is a reason the cyclicals have been doing well. Again, to me, the cyclical part of the trade is a lot easier to explain. What I'm struggling with is this combination, this odd coupling of cyclicals and defensives going up together.
So, Russ, the bond market's part of that story. It contradicts the whole story. In many ways, you're pointing to an ISM and better payrolls data, bond yields are lower. You can point to all of those things. CPI, the smallest downside surprise on CPI last week, unleashed a rally into the bond market. Now, Russ, people will be looking at that move today, looking at 10s around 4% and pushing back against all the people who said sell America and that maybe the bond market wouldn't provide that risk aversion in the equity market if we saw a sell-off. Now, do you think we have that reliable ballast back in the portfolio? Is that what the Treasury now provides?
So that's a great question. I wouldn't use the word reliable, but I'd say better. If you look at the correlation between stocks and bonds compared to where it was in 22 and 23, when inflation was a big concern, bonds were amplifying risk in a portfolio. They were not mitigating it. We've got back into an environment where we are seeing a little bit more of a negative correlation between stocks and bonds. I think that's reasonable, given not only the fact that inflation has come down, but also the volatility of inflation's come down. And historically, that has had a big impact on the relationship between stocks and bonds. Having said all that, and the reason I'm being a little bit trying to qualify my answer is compared to where we were 10 years ago, last decade, I don't think that correlation is as strong. So are bonds adding to risk? No. Are they as reliable of a hedge as they were 10 years ago? Probably not.
Russ, I'm just wondering if you put all of this together, how much it makes you uncomfortable to be part of the consensus. And I think about the consensus trade so far this year. It's overweight Asia, overweight ex-US, underweight long treasuries with a steepening yield curve, and overweight commodities. This is currently how the market is positioned. Then you have the market punishing people in those positions in short order as you get this sort of rotation of momentum. How much do you want to avoid some of these momentum trades because of what we're seeing in terms of the violent shifts, perhaps just on a technical level?
I think that's fair. And I do think you want to be cautious about the momentum exposure in the portfolio. We've seen the last couple of weeks, long, short momentum baskets have been crushed. High beta momentum has been crushed. So look, in an environment where you're getting these violent shifts in sentiment, particularly around what were previously crowded trades, I think it does make sense to bring in your risk. Now, having said that, I don't think a lot of these trades, particularly the tech and the AI, are as crowded as they were 6 months ago. Software, you're down 20% year to date, more if you add some of the losses from late 25. So the notion that AI and the hyperscalers are still as crowded as they were 6 or 9 months ago, I don't think that's quite right.
How much of a risk event is NVIDIA's earnings that come next week?
Well, I think the crossbar is a lot lower. And the truth is, NVIDIA is actually, it's been a little bit of a different story. But if you look at the semis in general, despite the fact that there are all of these concerns about tech and AI, those so-called pick and shovel trades, particularly the memory trades, they've been doing phenomenally well. And you look at the outperformance of semis versus software, really since the November low, semis have not been where the problem is. It's in other parts of the tech space.
Russ, it's good to see you. We'll leave it there. Thank you, sir. Russ Koesterich of BlackRock. Russ, thank you. Plenty to chew on. The contradictions in this market. You mentioned NVIDIA. NVIDIA trading softer for 2 consecutive weeks. Now, to Russ's point, you'd expect the whole semis complex to rally off the back of the capex that's been announced. We've not seen NVIDIA participate in quite the same way.
Or AMD, or Qualcomm, or Broadcom, or any of these picks and shovels aspects of the trade, which, I mean, to Russ's point, how much does that lower the bar then for next week? I mean, NVIDIA waits about 4 months before they release their first quarter earnings. And when they finally do in, June or next week, we're going to essentially have a pretty low bar for them to say, we're the ones that are minting cash. So guess what? You guys can take your worries elsewhere.
Feels like 5 years at the moment.
Yeah, indeed.
The wait, at least. NVIDIA in the pre-market negative another 1%. With an update on stories worldwide with your Bloomberg brief, let's cross over to Yahara Arnott for more. Hey, Yahara.
Good morning, John. President Trump says he's speaking with his Chinese counterpart Xi Jinping about weapons sales to Taiwan. Speaking aboard Air Force One, Trump said he would make a decision soon on the matter. China has previously warned the U.S. to handle arms sales to Taipei with the utmost caution. Meanwhile, Goldman Sachs is planning to remove race, gender identity, sexual orientation, and other diversity factors from the criteria its board uses to identify potential candidates. The Wall Street Journal reporting the decision follows a request from the conservative National Legal and Policy Center, which owns a small stake in the bank. And Apple is preparing for a major product launch in the coming weeks. The tech giant is reportedly preparing to announce several new devices following earlier reporting on new planned models, including new MacBooks, iPads, and the iPhone i17e. The event is set for March 4th with coverage right here on Bloomberg TV. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, big tech's big sell-off.
There's a lot of creative destruction that's taking place in markets today. And AI is chiefly responsible for that. The ability for this to create contagion and become a bigger financial event, I think, is relatively low.
A conversation up next with Momei Qu of PSP Growth. Live from New York City this morning. Good morning. So here is your week ahead. The next 48 hours, interesting. Fed minutes coming this tomorrow afternoon. And then the main earnings report. Walmart up 20% so far year to date. A massive rally with a big multiple as investors crowd into this one. That's the one to watch this week on the earnings front.
What I want to hear from them is what they're doing on AI, how they're improving margins using technology and using the negotiating heft, and how much they're gaining share, not only from Target, but from Kroger's and all of the both grocery stores, as well as from Amazon, their main competitor, arguably, as they become increasingly a tech company.
You went straight to fundamentals, of course, and we'll talk fundamentals later this week. But
how could I?
How much of this move is about fundamentals over the last few weeks?
Well, I could argue, I could make a strong fundamental case, but frankly, I cannot answer that question after we just had confusion or confusing or some iteration of that in the past, couple of minutes. We said it probably 15 times, so I'm not going to give you an explanation.
Staples, record highs. Staples on the S&P 500, record highs. Equity futures pulling back this morning, down another 0.4%, down by 0.8 on the Nasdaq. Check this out. In the UK, it turns out if you tax jobs, you'll get less of them. Sterling, negative 0.33%. Unemployment, 5-handle in the UK. Really concerning stuff. They've raised the minimum wage. They've increased payroll taxes. And what's happened? The labour market has softened. That's not just my view. That's the view of Catherine Mann of the Bank of England and others too.
Well, look, you're seeing unemployment rates in the United Kingdom rise to the highest levels, going back to the height of the pandemic. In a worrying sign for men ages 18 to 24, the unemployment rate has reached 17%. That's nearly 1 in 5 young men. That is the highest in a decade, even as unemployment rates for other cohorts remain somewhat below that. This is a concerning backdrop on a multitude of levels.
135.88 on cable this morning. Out of surveillance this morning, big techs, big sell-off.
A lot of the risk is concentrated in one segment of the market. I see this as a repricing in a segment of the marketplace that people are trying to get a handle on. There's a lot of creative destruction that's taking place in markets today. And AI is chiefly responsible for that. The ability for this to create contagion and become a bigger financial event, I think, is relatively low.
So here's the latest this morning. AI disruption rippling through markets with the Nasdaq 100 coming off 3 consecutive weeks of declines. Momei Qu of PSP Growth writing the reasons causing the sell-off seems to be at odds with each other. Painting all tech with a broad brush is not rational. Momei joins us now for more. Momei, welcome to the program. Let's just take it from the top once again and think about what's been announced over the past few weeks. A massive amount of capex intentions across just 4 companies, and yet Nvidia started to trade softer over the past 2 consecutive weeks. Momei, what do you think is behind that? Why are we seeing a decoupling from one of the biggest picks and shovels and the capex intentions of some of the biggest companies on the planet?
Yeah, good morning. There's definitely a lot of fears in the market right now, and not everything's really rational. So if you look at some of the main reasons for the sell-offs last week, in the weeks prior, I think some of them are actually at odds with one another. You're seeing softness in some of the Mag 7 due to the massive spending in CapEx and the concern that maybe those investments are not going to make a return. But yet at the same time, software stocks are being hit because of the exact AI disruption that's happening that might threaten them. So in my head, those two are actually at odds with one another, which makes me think that there's a broad fear in the market that's not very rational. So I think if you look at NVIDIA with the other bigger companies, there's probably a lot of not rationality in those either, in that people might think NVIDIA has been overpriced. People are already thinking the promises have been made too high. So as of now, NVIDIA can beat earnings. They can do everything right, but yet the expectations are so high that the market is not being very rational right now.
Momei, let's take those two extremes. Either it's going to disrupt everything and crush a lot, or it's a waste of money. Do you pick one or the other, or is there something in between?
I think it's something in between. I think one of the fears that's causing all this fear in the market is I do think there's going to be quite a few losers in the AI race. You're not going to have every company become the next big giant in AI. But I do think painting everything with a broad brush is also not rational. If you look at sectors that have more verticalized knowledge, that have more verticalized processes, those are not going to be disrupted the same way as the rest of the market. For example, we see that Procore and Autodesk has been hit pretty hard in the construction software stock. We own two construction tech companies in our portfolio, OpenSpace and HiArc. They're doing quite well. They're very resilient. We're seeing the customers, they have general contractors on the job sites. Those general contractors working every day is not going to all of a sudden wake up and find a way to find engineering talent to work with OpenAI and Anthropic and build their own AI tools. So we think for some of those industries, you're going to be a little more shielded than the rest of the market, and painting them with a broad brush is not rational.
Momei, how do you know, though, what's rational and what's not rational? On one hand, you've got a lot of people talking about what you're saying, who has a moat around them that can be protected from AI disruption. Then you've got an AI safety researcher over at Anthropic quitting and saying that the world is in peril and going to write poetry. Which is it?
That's $1 million question. And I think it's going to shake out differently in different parts of the sector. Some sectors, as I mentioned, will be more resilient, and others with more simpler workflows, like you see higher disruption in, say, CRM and the legal space, because those are more structured data. Those are more prone to disruption with large language models. I think on the safety side, that's an interesting trend that we're seeing too. In my head, it's actually a maturity of the market, the maturity that the market thinks AI is going to be more mainstream than before. If something is simply experimental, you're not even going to have AI researchers at the companies, never mind safety researchers that are ringing alarm bells. That's something that needs to be done about the guardrails. So I think it's good that we're paying more attention to safety and security and regulations. And I think those are both the public markets and the private markets, those are the companies that's going to show more resilience as well in this market.
We're seeing more of a focus on safety in the United States in particular, also in Europe. How much is this a reason that people are going toward Asia tech, where it seems like there's more of an emphasis on growth and less on the potential constraints?
I think it's definitely part of the reason. And I think you're definitely seeing more activity in Asia now, right? Like we're seeing all this activity within India investing all these dollars in AI. So I think safety is one reason, but I also think it's momentum. You've seen a lot of activity already from the US and the Europe markets investing in mainstream AI, and Asia is now all of a sudden announcing that you're investing heavily in mainstream AI. So I think it's both the safety piece as well as the momentum piece that we're seeing.
Hey, Momei, lots to think about. Another big contradiction in this market at the moment. Momei Qu there of PSP Growth, and a sign that maybe Washington is going to start to push back. Senator Sanders going into the long weekend. This did not get enough coverage. If the Microsoft AI chief is right in his forecast that ultimately we could wipe out in the next 18 months most white-collar jobs, he says if that's true, it's an economic earthquake. We need a moratorium on AI data centers to make sure AI works for workers and not just billionaires. And he won't be alone down in Washington.
Frankly, if we start to see this come to pass, it will be the pitchforks that come out. So it will be a significant social issue. Question here, how do you, though, compete if this is an existential issue? How do you compete with the likes of Asia that don't have those safeguards while continuing to be responsible? It is a conundrum wrapped in an enigma, and that seems to be where we are right now.
Up next, we'll catch up with Terry Haines of Pangaea Policy as the Pentagon threatens to cut ties with Anthropic. Just about avoided
a fourth consecutive day of losses on the S&P 500 with a gain of positive 0.05% on the S&P. Really muted bounce on Friday. Picking things up after the long weekend, we're down again. We're down a third of 1% on the S&P. We're down by 3/4 on the Nasdaq. The big tech players, Apple, Amazon, much softer through last week. Amazon on a 9-day losing streak, the longest since July 2006, down 18% over that period. Down again this morning by 0.4%. The prospect of 10 consecutive days of losses for Amazon. But it's not just tech, it's the banks as well. Citi last week down by 10%. Wells, Bank of America down by 7%. JP Morgan down by 6%. Financial softer pretty much every single day last week.
Yeah, is this going to be disruptive and creating new engines of growth that maybe disrupt certain business models? Or is this going to fizzle out and be overspending simply because we are heading into a downturn in the economy? Which is it? Pick your poison. This is a confusing market. And frankly, the contradictions are so great that so many people are just putting up their hands and saying, I don't know.
Risk aversion, pushing money into bonds, yields down across the curve. We're down another 2 basis points on 10s, 4.03%. New lows for the year. Earlier in the session, 4.01% on a 10-year maturity. That move going against the grain.
Yeah, and what you saw last week was the 20-plus year Treasury bond ETF having its best performance going back to Liberation Day in April and the recovery from that. So a question here about whether this is pricing in more rate cuts, whether it's pricing in more recession, or whether it's pricing in a more fiscally responsible Japanese government, which seems to be part of what's fueling it. Also, when you talk about the Bank of Japan indicating they probably are going to hike rates in April, it also has that component. But really, it has been a huge rally at a time when this is the absolute opposite of what everybody was positioned for.
30s down by 2, almost 3 basis points lower this morning, 4.67. As we count you down to the open about 3 hours away, let's get you some morning movers. Lots out there. Here's Yahara with more. Hey, Yahara.
Hi, John. We start with Norwegian Cruise Line Holdings. Those shares are soaring in the pre-market on hopes that Elliott management can help engineer a turnaround at the struggling company. That's because the Wall Street Journal is reporting that the activist investor has built a more than 10% stake in the company in an effort to help it catch up to rivals like Royal Caribbean and Carnival, which have done a much better job capitalizing on consumer demand for cruise lines. So those shares are up 8% in the pre-market. And turning to the latest on the drama, Warner Brothers Discovery, Paramount, Netflix, we are seeing Paramount Skydance shares rising nearly 3% in the pre-market. Honor reporting that Warner Brothers Discovery is considering reopening its talks with Paramount after it received an amended offer which addresses key concerns. But the reason this latest development is significant is for the first time we're reporting the board is seriously considering that Paramount's offer could lead to a better deal or push Netflix to up its bid. And we end on Infosys. Those shares are rising nearly 4% in the pre-market after the company announced a new partnership with Anthropic. The two companies will build custom AI agents for specific businesses. They're going to start in telecom and then move into areas like finance and manufacturing. This enterprise focus is, of course, is what Anthropic is known for. So this further drives its push to capture the AI corporate market. John.
Yahara, thank you. More from Yahara later this hour. On our radar this morning, the Bank of America Global Fund Manager Survey showing growing concern over AI spending. CEOs facing pressure to improve balance sheets versus increasing capex as clients worry about over-investing. Elsewhere, Alibaba shares rising after upgrading its flagship AI model Qwen. The latest version is capable of processing complex tasks and analyzing long-form videos. The move coming ahead of a much-anticipated release from DeepSeek. And finally, Goldman Sachs removing diversity criteria for board candidates, joining Wall Street peers in rolling back DEI mandates. The Wall Street Journal reporting the change follows pressure from activists and is expected to be finalized later this month.
Yeah, and this comes after they named the fewest number of partners going back that were female versus male, going back a number of years. Look, this is a widespread shift to sort of change the rules back to what they used to be. And you're seeing this across Wall Street, a de-emphasis. How much is this politically driven? How much is this something that's been in the making for a long time? I know that executives, including Jamie Dimon, said that it got a bit ahead of its skis and it was counterproductive. And how much is this? To me, it felt a little bit like pushing on an open door. This was something that people kind of wanted to do. And then they had a shareholder say, you should do this. And they're like, oh, I guess we have to.
They don't have values, they have balance sheets. That's always my summary of corporate America, that this was of its time several years ago, under tremendous pressure to go in this direction. And this is of its time several years later, under tremendous pressure to go in a different direction. And we should just remember that every time the pendulum swings, that these companies don't have values or morals. Ultimately, this is about balance sheets and stakeholders elsewhere.
Yeah, in politics, and frankly, in catering to a certain political vibe shift that has taken place, and ultimately that is how it has to be viewed. I mean, ultimately, how much has Wall Street moved on? They're not looking for virtue signaling right now.
Not at all.
They're looking for performance, and that ultimately is what investors are rewarding.
And to be fair, Goldman Sachs is delivering performance in a major way over the last year or so. Let's turn back to AI. Tensions emerging between Anthropic and the Trump administration. Defense Secretary Pete Hegseth considering cutting ties with the firm and deeming it a, quote, supply chain risk over disagreements on using its AI tool, Cloud. Bloomberg's Tyler Kendall joins us now from Washington for more. Hey, Tyler.
Yeah, hey, John, good morning. Well, this marks the latest in what has been months of tense negotiations over the military's terms of use when it comes to Anthropic's Claude. And the proposed limits, our reporting indicates, the Pentagon ultimately feels that this would be unduly restrictive and that the Pentagon wants to be able to use the tool as long as it doesn't break any laws. In fact, a senior defense official is now telling us that this latest rift is potentially bringing up the risk that we could see a cutting of ties altogether between the government and the company, with the Pentagon weighing, even asking vendors to certify that they are not using the models, depending on how these negotiations go. Now, Anthropic had entered into a 2-year agreement with the U.S. military last year worth about $200 million for its models built specifically for the U.S. national security apparatus. But as you well know, Anthropic has positioned itself as a more responsible AI company. And we did get a quote from a spokesperson for the company that is saying that they are still engaged in, quote, productive conversations in good faith. But tensions apparently seemed to flare last month amid reports that the U.S. government had used Claude in its raid and capture of the Venezuelan leader Nicolas Maduro. The Pentagon, it's also worth mentioning, is currently in negotiations with the other big 3 models, that's OpenAI, Google, and xAI. But Axios is reporting that the administration feels that those are really behind Claude in terms of development. John, Claude is currently the only model used for classified systems, and that could really complicate things for the U.S. military if we do see the Pentagon end these ties abruptly.
It's Tyler Kendall with the latest. Tyler, thank you. To extend the conversation, Terry Haines of Pangaea Policy joins us now for more. Terry, do we have a deep understanding of the consequences if you get on the wrong side of this administration and you're a tech firm?
Welcome to the fabulous world of defense contracting, John, and welcome Anthropic, more importantly. This strikes me as being about 2 things. One is it's about who decides to make the rules to utilize the thing that is being provided to the Defense Department, and the other is a supply chain issue. I'm not competent to talk about the supply chain issue, but I can talk about the first issue all day. And the bottom line is that if you want your thing to be used by the Defense Department, no matter what the thing is, and you've contracted to provide the thing, then you don't get to decide how the Defense Department uses it. It might be nice to think or pretend otherwise, but that's just not the way that's going to operate. So, seems to me Anthropic has more of a decision to make here than the Defense Department does.
It felt a little bit, Terry, like Anthropic's becoming or trying to become the anti-Palantir, and they're trying to take lessons to some of the controversy that Palantir has invited elsewhere. Is there another way to read this?
I think it's a savvy comment, Lisa. It seems to me that a lot of this, based on your conversation and what Tyler said and your own reporting at Bloomberg, has been a lot about internal struggles at Anthropic to define itself more than anything else. And as I say, I think they're crashing up against the reality of being a major vendor to the United States government.
It feels like there is a lot of angst within the walls of Anthropic. We're hearing about people quitting to go write poetry in the UK countryside. But at the same time, there is a sort of an angst developing in Washington, D.C. about how they regulate some of these technologies, given that, A, we don't understand fully how they're going to iterate, what they're going to disrupt, and what the implication is going to be for the labor market. I mean, how much does Bernie Sanders have company on the far right of the spectrum based on some of the expectations of what AI could do?
Well, a couple of things. Bernie Sanders gets treated as a canary in the coal mine, a lot of times. And at the same time, Bernie Sanders has no legislative accomplishments. Bernie Sanders is somebody who generally agitates and points in a particular direction. The Democratic Party has got a problem here because they're going to have to figure out whether the Sanders vision or somebody else's vision, a more business-friendly centric direction, is going to be the way that they go. That's been a perpetual problem since Sanders has been a major voice in the party. It's kind of on the administration side. It's been very clear. They consider AI to be a core matter of national security. We need to fight and win on at all costs, and they don't particularly care about the consequences. And that's very similar, I think, to the old Manhattan Project days. Kind of damn the torpedoes. We're going to go forward and deal with this and figure it out because we've got existential problems if we lose.
Terry, until their jobs are threatened, because this is a democracy. TikTok was once a national security threat, and then their jobs were threatened, and quickly their minds started to change down in Washington, D.C. Now, I want to understand from you, a man who has lived and breathed Washington for decades, what would happen and how they'd respond if the Microsoft AI chief is right and what he told the FT materializes, that in the next 12 to 18 months, as quickly as that, we can automate basically all white-collar jobs. And you started to see the unemployment rate go through 5 and approach 6, and people leaving university, like right now, they can't get jobs. Terry, how would they respond down in Washington?
Well, I think two things, John. One is that putting aside the self-promotion of the Microsoft AI guy, Washington has two reactions. One is to treat with great skepticism whatever the perceived crisis of the moment is in the markets. What Washington sees, frankly, is the longer game, where there have been huge upticks in the markets, and now you see a little bit of wobble. Washington saw a wobble in tech stocks last November for different reasons, but it did. So they'll let that play out a little bit. Firstly, secondly, it's going to get a whole lot more worse. A whole lot worse before Washington reacts at all. And then the playbook always is, what I view as kind of scraps, retraining programs and the like, that didn't really move the employment needle a lot in the 90s for blue collar jobs. But Washington, I will tell you, generally speaking, particularly in an election year, is not going to shed a single tear for white collar jobs going away. That's not beneficial to either party, and they will look at it as an outlier compared to the kind of things that happened over the last half century.
Terry Haines of Pangaea Policy. Terry, appreciate your opinion. Thank you, sir. Down in Washington, weighing in on the prospect of maybe the most extreme example developing in the next 12 to 18 months.
Yeah, although this is the confusion part, right? Is this self-promotion, or is this a true warning shot about some sort of dystopian future that we have waiting for us? I mean, ultimately, we don't know, and that's the reason why there are these sort of confusing crosswinds. Do you hide in toilet paper and crackers that can survive 10 years, or do you go into some of the disruptors that potentially could benefit?
Is it just a marketing story? We talked about this with Anthropic. Are we just trying to justify very lofty valuations ahead of some big IPOs later this year?
And maybe it would take disrupting the entirety of white-collar America in order to justify some of these valuations and some of the capital expenditure plans that some of these companies have.
Equity futures this morning slightly softer. We're down by a third of 1% on the S&P. With an update on stories worldwide with your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. UK unemployment reaching its highest level since the pandemic, and wage growth falling to its lowest level in more than 5 years. Youth unemployment bearing the brunt of the hiring slowdown, the data prompting traders to raise bets on BOE rate cuts. Meanwhile, President Donald Trump praising Vice President J.D. Vance and Secretary of State Marco Rubio, the president stopping short of saying he would support either one of them to lead the Republican presidential ticket in 2028. The questions coming after Rubio received positive reviews at the Munich Security Conference and even a standing ovation after his speech. And Jesse Jackson, one of the most prominent U.S. civil rights leaders, has died at the age of 84. The two-time presidential candidate was a Baptist minister who advocated for equal employment and opportunities for Black Americans. Jackson was a longtime crusader in the U.S. and abroad, advocating for the poor and underrepresented. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. Up next on the program, the Fed's rate debate.
The real debate this year on the Fed is where neutral policy is going to be. They're at 3.5 now, so that implies 2 more cuts. Getting another one in would, be the result of more disinflationary pressure.
Up next, Stephen Juneau of Bank of America, live from New York City. You're watching Bloomberg TV. The equity market coming off the worst week of the year on the S&P 500, adding to the losses this morning following a long weekend. We're down by 1/3 on the S&P. On the Nasdaq, we're down by 0.8. Under surveillance this morning, the Fed's rate debate.
The real debate this year on the Fed is where neutral policy is going to be. They're at 3.5 now, so that implies 2 more cuts. Getting another one in would, be the result of more disinflationary pressure. We're looking for inflation to moderate back to target this year. So that, in our view, would be consistent with the Fed that's easing somewhat.
So here's the latest. Check out the bond market this morning. Yields heading for lows of the year with another busy week of data on deck. Investors betting cooling inflation will ease the path for the Fed to cut interest rates with core PCE due on Friday. Stephen Juneau of Bank of America writing, Fed officials really need to see the data weaken or it's going to be really hard to justify cutting. Stephen joins us now for more. Stephen, good morning.
Morning.
You say fade any signs of weakness. Ultimately, at Bank of America, you and a team are super bullish growth. What underpins that?
Well, I think, plenty of tailwinds. So we have fiscal stimulus this year. If you think about what the Fed's done over the past 2 years, they've cut rates by 175 basis points now. So that should be supportive. We're of the view that they're actually kind of near neutral, if not accommodative territory. Of course, you have AI still. That's a tailwind, we think, for investment. And we think we're going to start to see that spill over to other sectors. And generally speaking, when you have an improving economic outlook, you start to see better investment come not only just from AI, but from the breadth of the U.S. economy.
Is GDP decoupling from payrolls?
A little bit, for sure. But our expectation is that over the course of this year, that can't last, right? So last year, I think, was a story of the wealth effect, of the K-shaped economy. This year, I think we're going to see that relationship reaffirm, realign, where we do start to see job growth move higher. It's not going to be the 200,000 jobs that we had over the past couple of years when we had that positive immigration boom. It's going to be closer to, say, 60,000, 80,000. But it's going to get nearer to where GDP is and help us to.
You say that can't last. Why can't it last? What changes? It's a new year, different number, 25 versus 26. But what's changed?
What's changed in terms of the job growth numbers, I guess? So what's changed this year, I think, in terms of last year, in terms of the wealth effect, I guess what you're saying is that I just don't think you're going to see AI drive, say, 20% returns in equities, something like that again this year. We're expecting something more typical. Savita Subramanian of our team, of course, is looking for something like 5 to 7% return on equities. So you're not going to get that significant of a wealth effect this year as you did last year. So you need to see that job growth pick up in order to see the economy run closer to, say, 2.5%, which is what we're predicting.
Well, it could run much hotter if the Fed would just cut rates significantly. And everyone says that the bar, and you just said that the bar got a lot higher because the data isn't cooperating. Well, does the data have to cooperate with a Kevin Warsh Fed?
I think it does. Because Kevin Warsh is just one person, right, when you think about it. We haven't seen a big shift. Of course, the Lisa Cook case, I think, was a positive for Fed composition, for Fed independence. You're not going to see a lot of turnover unless you see people kind of voluntarily leave at this point. So then you're swapping maybe Warsh for Myron, maybe Powell retires. And then how do you get enough votes to actually just engineer cuts without having the economic justification for it?
So you're saying right now that the market is completely offsides. The market now is pricing in almost 3 rate cuts for the remainder of this year. You have a 2-year yield that's now close to the lows that we've seen going back to 2022. This is a market that's pricing in a very different Federal Reserve than what you have envisioned. Is that correct?
I wouldn't say completely offsides because I say all this and I would say we're still penciling in 2 cuts. So we do think Warsh probably can get a couple through. The Fed's long-run estimate of neutral is at 3%. We think they can basically cut to that long-run estimate of neutral today. But I do think the window's closing a little bit more and more because we got a very positive jobs report. We got an inflation report that is fine. It's not too hot, not too cold, obviously, but core PCE is likely going to be at 3% in December and January. That's not a number that the Fed really wants to embrace, right? So, and you have a lot of hawks on the committee right now who aren't supportive of lowering rates. So you need kind of that economic justification. So we do think the risk around our forecast is towards fewer cuts, not more cuts, if the economy holds up as we predict.
Why do you believe the data? And this is people probably are rolling their eyes. Are you a conspiracy theorist? But so many people said 130,000. It looks good, but look under the hood, it's terrible. I mean, how many different research items did we read on that? I mean, why are you pushing back and saying if it looks like a duck and it quacks like a duck, guess what? It's a pretty good jobs report.
I think it's the full spectrum of the report. The unemployment rate was down. Yes, jobs are better. Even manufacturing jobs are positive for the first time in a very long time. So you got a little bit more breadth. Hours worked was up. Income was up. So the breadth of the report was very positive. Now, I will say that January is always a very messy report. So we want to see February. We want to see March. So what it did for us was basically reaffirm that, at least under Powell, we're not going to get a cut. And then we think, if you shift towards, say, Warsh's FOMC, I think you're going to have to see some data kind of green light cuts at this point.
So tax refund season. Yep. Right in it, people are expecting the numbers to be quite big. Where you're maybe different versus others is that a lot of people think the effects are going to fade pretty quickly and the second half's going to be weaker than the front half. What separates you from the pack?
Well, I think it's all those other tailwinds, so it's not just that. So the tax tailwind should really be more of a 2Q story, I think, in terms of consumption. You're absolutely right in thinking that spending from tax refunds, it really has a short lifespan. It gets spent relatively quickly. What doesn't get spent, well, it gets paid towards debt or it gets invested. But it's those other tailwinds that start to pick up. It's that breadth emerging from investment. It's the fact that the Fed's easing last year keeps financial conditions very accommodative. So all those factors start to kick in the second half of this.
So by the time we get to the second half, we're not just hiring in healthcare.
Exactly.
You actually see us beyond healthcare.
Yeah. We think we could see it in construction. We could see manufacturing have a little bit of a renaissance, and some other sectors too.
So you'd call it a real economic boom then, potentially, by the back end of this year?
Potentially. I mean, I think you're going to see it throughout this year. Looking back at last year, despite the uncertainty shock that the economy faced, we grew, at 2%? I mean, we're going to find out on Friday this week what exactly we ended up at. That's despite a very big shutdown, a 6-week shutdown. So why can't we grow at 2.5% this year?
Stephen, it's good to see you. Stephen Juneau there of Bank of America. It's so odd to have this conversation with the bond yield of 4% on 10s and threatening to break into the 3s later today.
Well, I would like the Microsoft AI chief executive to come on and face off with Stephen Juneau about what the potential is for a potential broadening boom in employment later this year. On one hand,
so many contradictions out there.
I mean, this is exactly what I'm coming to. I mean, this is a reason why this is such a confusing market. On one hand, all white-collar jobs are dead in the water. On the other hand, we're entering an economic boom. Pick one.
Construction, manufacturing, all of the above right now, which is why people are hiding in Walmart. Basically, that's the story, and hiding in bonds too. Hiding from a lot of things, and a lot of things don't make sense. Momei Qu was talking about this, the Nvidia trade. If you believe all this money is going to be spent, why isn't Nvidia winning? Why is that trading softer over the past 2 weeks? So much of this doesn't stack up.
How do you discern narrative versus the momentum trade that's unwinding? Technical versus a narrative that is actually sustainable? That is the difficult thing. And then how do you have the discipline to push through any kind of momentum unwinds and have conviction? That right now is the challenge.
Nvidia down by another 0.8% in the pre-market. The broader stock market on the S&P 500 down by about a quarter. The conversation continues. Up next, we'll catch up with Dan Skelly of Morgan Stanley Wealth Management, John Lieber of Eurasia Group, Kylie Cohu of Jefferies, and Earl Davis of BMO on a bond market that's on quite a rip-roaring rally at the moment. Yields are lower once again this morning, down by 2 basis points across the long end of the curve. From New York City, the second hour of Bloomberg Surveillance. Up next.
Affordability issues are at the forefront right now.
We are seeing disinflation kind of gradually unfold across the economy.
If you're at 2.5%, you're basically at your target.
Ultimately, we think growth is going to be okay this year.
The economy is fundamentally healthy, and I think it is going to accelerate.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
There is a big divide on Wall Street at the moment, that's for sure. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures resuming losses. We're down across the board. Negative 0.3 on the S&P, negative 0.7 on the Nasdaq. In the bond market, switch at the board. Yields lower across the curve. We're down 2 on 10s, 4.02%. New lows for the year going into this. Later this week, Fed minutes tomorrow afternoon. Look out for that. Plus, earnings from Walmart on Thursday following a major rally for consumer staples.
Yeah, how high is the bar at this point for Walmart based on valuations, and how high is the bar in order to determine, typically when Walmart reports good earnings, people say, oh no, the sky is falling, that means the economy is bad and people are piling into staples. When they report bad earnings, oh my goodness, not even the biggest retailer in the country can actually perform well. The sky is falling. Has the narrative shifted around Walmart as it shifts to the Nasdaq, as it talks about some of the tech advancements? How do they become a tech name that's not going to become disrupted, but will be ultimately the disruptor at a time when people are looking for safety? How high have we just pushed that bar?
At a 40-50 multiple.
Yeah.
The PE is wild on that name. We'll get to that story later this week. We need to talk about the great contradictions both in the equity market and in the economics profession right now. We just spoke to Bank of America, talking up a boom in the economy, and later this year, a broadening out of the labour market beyond just healthcare hiring. And yet at the same time, to your point, you've got the Microsoft AI chief speaking to the Financial Times saying all white-collar jobs in the next 12 to 18 months could be automated. Which one is it?
Well, we can get the Anthropic AI researcher who's off in the UK, who's doing poetry right now, writing and studying poetry. Please write in and let us know what you're thinking about. Look, we have a bifurcated kind of messaging coming out. Either it's going to make us all more productive and open the next nirvana of human existence, or it's just going to destroy human existence as we know it. And ultimately, you've got these two polarities and no way to counterprove either of them. So it's a very difficult moment, and that's the reason why there are so many contradictions in the markets. There is an effort to seek safe havens. The idea that, if you mentioned this many times, that treasuries are that haven, notable. The fact that the dollar is not, also notable. The fact that gold is acting as though it's just simply on a swing, going up and down, gives you a sense of just how much volatility has been embedded here. People don't like uncertainty, and that is the defining characteristic of what this is.
After all that, poetry in the UK sounds pretty good, doesn't it?
I get it.
I'm on board.
I
sort of retired to the British countryside.
I mean, you're pushing me into an open door.
Into the Cotswolds. I can write some poetry. Would you like to read that?
I would love to.
Would you come to my recital? I'll find a quaint British pub.
I would love to.
We can stream it.
I think that this sounds great. I think that you will
there
be gone next
week.
week.
We can make this happen. Coming up on the programme, we'll catch up with Dan Skelly of Morgan Stanley as equity surge to a bottom, Kylie Cohu of Jefferies as investors pile into Walmart ahead of earnings, and Earl Davis of BMO with bond yields hitting new lows for the year. We begin this hour with stocks lower following 2 straight weeks of losses. Dan Skelly of Morgan Stanley expecting more churn, writing, we are watching closely for signs that indiscriminate AI-related selling is beginning to slow. Until then, we remain relatively defensive. Dan joins us now for more. Dan, good morning.
Morning, John.
Are you seeing that indiscriminate selling over the last week?
We sure have, and it's been across a host of different categories, whether it be insurance, wealth management, trucking, logistics, you name it. And I think beyond that, John, we have 2 things going on. First is we have this global reflation trade going on where the U.S. has ceded leadership for the first time in over a decade overseas. You have Korea, Japan, LATAM, other parts of international up a lot this year on continued momentum and fiscal spending over there. And then you have this AI disruption trade. It feels like the S&P bull market has paused, and the bull market in AI disruption and hysteria has really taken off.
Which bits of the AI disruption bull market don't make sense?
Yeah.
What calls it indiscriminate? What labels that? How do you define it indiscriminate at this point?
There's just a tremendous amount of dissonance right now. When I think about dissonance, it almost always happens in market cycles around innovation, whether it be internet, mobile, cloud, GLPs going back several years ago. Today, the dissonance is around AI. You have both market discounting AI counterparty risk in terms of the model makers and software. You have AI, you have large cap quality leaders lagging. You have small caps leading. Isn't it the small caps that are going to be the most disintermediated by AI and who can't invest in the tools themselves? So you have a tremendous amount of indiscriminate selling at the moment.
So it sounds like at the moment you're hands off. You don't want to step in. But have you got the itch to step in? And which pocket of the market do you want to lean into ultimately when it comes to that moment?
So that's a fabulous question, John. And we are, in fact, telling people to be proactive. On the first front, we are telling folks that international can continue to catch up. We think that goes on. And then secondly, we would just argue large cap quality across financials, number one, healthcare, and industrials seems to be a place to lean in right now.
There was a really interesting post of Nicholas Bustamante. He's the CEO of an AI company that advises different financial assets. And he's talking about how there are certain moats that can be established around software companies. I just wonder if you've established some sort of test of what kind of moats would have to go into place to be a positive for a company and make them undisruptible.
Sure. Number one, are the AI model providers themselves a partner and using you? And when you look at behind the onion at some of these different models, they're using the SaaS companies. They're partnering with them already. They're customers of them. I highly doubt that these private AI model makers who are coming public, widely discussed later this year, entire business plan is to put some of their big, large, liquid sectors of the market out of business. Who will be left to pay for them in the future? And so I think when you think about moats, number one, who's being utilized already within the AI ecosystem, who has proprietary and highly regulated data, and that might be within healthcare or financials. And then secondly, who's embedded in the workflow and who isn't standing siloed on an island. Those are some of the attributes that we're looking at.
So if that's true, how as an investor do you view some of the warnings coming from the C-suites of some of these big tech companies saying that all white-collar work is going to be eradicated in the next 5 years?
Sure, I think you've heard that from a more isolated set of individuals who candidly have their own biases in trying to provide certain niche product. I think when you look more broadly, look at the macroeconomic data over the last 2 weeks. We had a surge in job growth. We had a dip in the unemployment rate. What people aren't talking about is this broader reflation and economic broadening that we're seeing. And in the longer run, Lisa, to your question, we think AI is more complementary of jobs than replacing. It's essentially going to replace a lot of the lower value-added tasks in a day and not at the moment be replacing roles holistically.
Ramo's not buying it.
Well, it's not that I'm not buying it. It's just that either you get that broadening out or you don't. If you get that broadening out, then it actually makes sense for some of the valuations to be coming in and deflating a bit in the big tech sphere. If you don't get that broadening out, maybe it justifies those valuations, but it certainly doesn't justify the sort of scope of how much people are going into that. It just goes to another contradiction, fundamental, endemic in this market.
So it's a great point. I think the number one thing the market, the S&P 500, let's remember, is a liquid large cap index, is waiting for is when do the highest quality names that are the adopters start to monetize AI. I think the market, rightfully so, is taking a bit of a breather on spending. Right? The Mag 7 had spent wildly the last 2 years. It even upped its CapEx expectations again this year to over $700 billion. And so I think the market, efficiently and rightfully so, is taking a breather on spending and waiting for the adoption phase to start to see monetization in the earnings. And I think that's when the broadening can actually start to go into this new phase, right? At the moment, everyone's saying the adopters are going to be those who are most disrupted. That's the point that makes no sense at the moment.
So, Dan, listening to you and knowing your work, you believe there's a little bit of a spread right now between fundamentals and the narrative.
No doubt.
And clearly the earnings are holding up, without a doubt. But the narrative is really compressing the multiple. And the narrative is difficult to prove, difficult to disprove. And we've been talking about this over the last several weeks. How do you prove the negative, disprove the negative and say these things won't happen? What's going to make that cloud, that very dark cloud, drift away from these multiples? Because that's what's holding the whole software complex back at the moment.
You know, it's such a good point, and there's an index level perspective, and then there's underneath the index. Underneath the index, for those subsectors that were most indiscriminately sold in the last month or so, they need to prove themselves out in terms of empirically, how are they utilizing AI to get more efficient and not being disrupted? And then secondly, at the index level, the market mathematically has to regain confidence in Mag 7. I mean, period, end of discussion. Mag 7 is 40% of the index. And so for the market to regain that confidence in the Mag 7, again, it needs to see the Fortune 100 quality names start to show AI in the earnings upside.
And we're not seeing that right now.
Not yet.
Amazon super weak. Apple hammered last week. Apple was down, 7% in 2 days last week.
And Apple was the one Mag 7 not spending on AI.
So make sense of that. So again, I'm going to ask you a different question. Same question, but on a different part of the market. The Mag 7 right now, and I know you can't do single names, but the kind of companies you'd want to buy, given the indiscriminate selling across the biggest names in this market, what would you be buying?
Yes, I think there is room right now to pick off software. We've got the space down 20%. So again, looking for those leading software names that have software and cloud, that have other upside optionality related to AI, number one. Number two, we would say look at some of the industrial names that are providing power. You've got this huge spread, to use your phrase, in terms of semiconductors and some of the new winners. But when I look at some of the old winners in terms of industrials, utilities, et cetera, who are powering AI, they look cheap as well.
You know, I was listening to a podcast over the weekend about technological revolutions and the influence on inflation. And there is a feeling that all of this will be disinflationary down the line. If you go back in history, the theory does not hold. Essentially, they have all been hyperinflationary periods of time for other reasons, and also because of some of the economic influence and the acceleration in the economy. Why is this time different that's giving people such conviction to go into long-term bonds to the degree that they are?
Such a great question, and amazingly, so that historical data, why should that matter today in markets? What a crazy thought. But another example, yet again, of dissonance, where you have this global reflation trade, you have mining and metals and gold, to your point earlier, all running wild, and then people just presuming we're not going to have any inflation. There's an article in the papers this morning talking about companies raising pricing again. And so, look, I would just argue, I think there is kind of a mountain and a near-term catalyst that you have to get over, and that does seem inflationary in the near term before you get to the disinflationary AI productivity nirvana. So we're in agreement with you.
So does that mean that right now you are aggressively taking action on some of these distortions, or are you simply saying ignore it all and go away from the United States because it's just too confusing to invest in right now?
We're saying a number of things. So number one, we don't want to be on the sidelines right now, just to be clear. We want to be proactively invested. And secondly, we've been recommending gold for over 2 years. We still like that trade. Number two, we have been saying to folks it is okay to stick with the international trade, particularly in parts of Asia that are benefiting from the new memory and CapEx spend in chips. So that's Taiwan, Korea. We also like parts of Latin America and Japan, based on some of the new fiscal initiatives we're going to see with the super majority from Takaichi and her party. So we're saying to do all of those things. And then lastly, in the U.S., the number one thing we're saying is don't forget about the top 100 companies in the U.S. across varying sectors that are incorporating AI into their business model right now, have yet to show the evidence. But where we are confident, again, looking at historical cycles, whether it was internet or mobile or social media or cloud, you go through 30 years of innovation cycles. It's always the large cap quality names that figure out how to monetize.
The move in Asia, Nikkei up by 12%, the Kospi up by 30% year to date. Wild. Dan, good to see you.
Likewise.
Thank you, sir. Dan Skelly there of Morgan Stanley Wealth Management, breaking down this equity market with an update on stories elsewhere. Your stories worldwide, your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. We're seeing Paramount shares rising in the pre-market. Warner Brothers has agreed to return to the negotiating table for 7 days to iron out the details of Paramount's most recent offer, which was raised to $31 per share. Warner Brothers is still recommending shareholders vote for its binding agreement with Netflix. Meanwhile, Iran says it's conducted Navy drills around the Straits of Hormuz, the vital waterway that ships about a fifth of the world's oil. President Trump has threatened to strike the Islamic Republic unless it agrees to a deal curbing Tehran's nuclear program in exchange for sanctions relief. The U.S. and Iran are set to resume talks today in Geneva. And Anthropic's talks with the Pentagon about extending a contract have hit a snag due to disagreements on guardrails. Sources telling us here at Bloomberg that Anthropic wants to put limits in place to prevent its Claude AI tool from being used for mass surveillance or for developing weapons that could operate without human involvement. That's Bloomberg Brief. John.
Hey, Yahara, thank you. Appreciate the update. Up next on the program, pressure building for results.
Prices are down, way down. We inherited a mess, and we've brought our country back very, very powerfully. Our crime numbers are way down. The country's doing very well.
John Lieber of Eurasia Group joins us next, live from New York City this morning. Good morning. Stocks are negative. We're down by 0.2 on the S&P, recovering slightly on the Nasdaq 100, down by 0.6% in the bond market. Notable bond yields at new lows for the year, down 2 basis points on the session, 4.03%. A fair bit to look ahead to. It's not a major week ahead. It's a shortened trading week ahead of us. But we've got this. Fed minutes on Wednesday, Walmart on Thursday, a sprinkle of Fed speak, and I think maybe more focus on jobless claims. Just how well is this labour market holding up, even rebounding, based on the data we saw just last week?
Did we get confirmation of messy January-influenced and weather-influenced data? Do we get a confirmation that things are holding in? Or is there this sort of pernicious difecta if we get increasing jobless claims and then a core PCE that looks something like 3%? How do you deal with a dual mandate in conflict at a time where people have existential concerns? We might be getting back to that. And then the Rorschach test that is Kevin Warsh.
It would be nice to have a ruling as well on tariffs later this week too, wouldn't it?
Sure.
Keep getting to those dates and we pass them by. Let's see if we hear anything going into the weekend. Under surveillance this morning, pressure building for results.
Low inflation, very low inflation. Prices are down, way down. We inherited a mess, and we've brought our country back very, very powerfully. Crime numbers are way down, despite the fact that they let in 25 million people, many of whom should not have been allowed into our country. The country's doing very well.
So here's the latest this morning. The president touting his accomplishments ahead of next week's State of the Union address as a new AP poll shows his approval sliding to 36%. Bloomberg's Tyler Kendall has more. Tyler, good morning.
Hey, John, good morning. Well, there does appear to be that gap between public sentiment and what has been relatively positive economic data for this administration. But according to polling, the White House has been firmly on the defense when it comes to the issue, as we know that price levels in particular have been a big driver of affordability concerns. And that's why we're expecting President Trump next week during his State of the Union address to tout what has been a flurry of new economic policies, not yet enacted and will likely face any pushback in Congress, but takes that more populist tone that the president has been trying to push forward. Now, of course, we've also seen the White House push ahead with policies that have already been enacted, trying to tout the fact that there will likely be larger refunds under the One Big Beautiful Bill this tax season and their push to onshore domestic manufacturing. But the question really becomes how much ground can they make up between now and November? Now, to be sure, of course, there are many months and anything could happen, but we did see two significant counterweights to the administration's agenda emerged last week. One is that the president himself authorized a pullback in federal agents on the ground in Minneapolis, seen as part of a bid to move negotiations along to reopen the Department of Homeland Security, which is currently shut down. And two, as you well know, and we covered on this program, we saw 6 Republicans cross party lines and vote against President Trump's signature tariffs targeted specifically against Canada. And those 6 Republicans, many of them represent key battleground districts, which is underscoring that some Republicans may feel that they need to go against the White House's agenda to advance their standing come November. John, it's really the House that we're closely watching here. Keep in mind, Democrats only need a net gain of 3 seats in order to flip that chamber, and we are currently seeing a historic number of Republican retirements, which could hurt that incumbency advantage.
Tyler Kendall with the latest in Washington. A note for Democrats at the moment, maybe avoid talking about foreign policy. Governor Whitmer and Congresswoman Ocasio-Cortez over the weekend at the Munich Security Conference absolutely bombed. Forgive the pun, but seriously, bombed.
Well, a lot of people were saying this, that AOC, this was her first international event on the world stage, and definitely hit a note that was not appealing and seemed to turn a lot of people off. So it does raise a question. Can that be really the front runner kind of vibe coming from the Democratic Party?
How did they go to a conference like that and appear on panels so ill-prepared for such obvious questions about foreign policy? Wasn't that shocking?
It was shocking, and it raises issues of are people not challenging them in the same kind of way in the United States?
Precisely.
In asking hard questions that really need to be answered.
Spending too much time on home turf and getting very comfortable interviews. Joining us now, John Lieber of the Eurasia Group. Now, John, I imagine that doesn't really matter when it comes to the midterm because foreign policy doesn't seem to be the big issue at the moment. Is that fair?
Yeah, that's right. I mean, well, to some extent, it's correct for the midterms. Donald Trump's big issue in his presidency so far, however, has been foreign policy. And even though they'd probably like to be talking about domestic policy and like to be talking about job creation and economic growth, foreign policy keeps dominating the news because Trump's been extraordinarily active on that front. Venezuela, Iran, Greenland, it's everywhere. So for the midterms, yes, foreign policy doesn't matter so much. But for the presidential primary and for President Trump himself, foreign policy is the key defining issue of this presidency so far, and I think it's going to be a big issue in that primary, like you heard these two talking about it in Munich.
On an international level, I read the Munich Security Report. It was quite the read. The headline was, "The world has entered a period of wrecking ball politics," talking about how the United States is no longer the shepherd or really the overseer of the world order. And I just wonder how that's resounding in the United States. I mean, is that resonating, or is domestic focus on completely other things?
I think that Donald Trump ran on a platform of isolationism from the rest of the world, saying that this system that the U.S. had created over the last 80 years was fundamentally broken and had betrayed American workers. So I think that some guys in some country most Americans have never been to, writing a report that says that system, that Donald Trump has now fundamentally broken that system and there's no going back, might not be that bad of a thing for Trump himself or anybody else running for president. So I think that in a way, from a domestic political stance, it's an endorsement of his policies. Now, I don't think voters want to see chaos, and I don't think they want to see things like invading Greenland. They probably don't want to see invading Iran, and they probably aren't that excited about invading Venezuela. But he's getting targeted wins here, and he's keeping Americans out of long-term entanglements, which was a huge problem during the Bush and Obama administrations. So in many ways, I think that this reordering of the system is probably a good thing for Trump, and I think it's probably a political victory.
It might be a political victory in terms of messaging on one hand, but on the other hand, a place like Canada, which is the biggest importer of U.S.-made vehicles, talked about how a greater proportion of the population than not would be okay buying a Chinese electric vehicle right now for a cheaper price, which seems to be more feasible considering that they're lowering tariffs than, say, a year ago when that wasn't the case. I mean, how much do you think that it's going to shift some of the trade partners and some of the export lines that the United States has?
Yeah, that's absolutely the case. I mean, the problem with alienating your allies is that they look for new places to get their security from, and they look for new places to trade with. The issue is they just don't have a lot of places to turn, particularly Canada. So they can shift around their alliances. They can look to the EU. They can look to China, but the U.S. is going to be their largest trading partner. Trump knows that. He's probably overplaying that hand and alienating some of these people. It is starting to cost Americans in terms of export destinations and potentially jobs. I think that's one of the reasons you saw those Republicans, those 6 Republicans in the House last week, vote against the Canadian tariffs, because they recognize that this is a sensitive issue with voters and it potentially costs jobs in their trade-exposed districts, given how many exports end up going into Canada as part of the automobile supply chain or in other areas.
Hey, John, it's good to catch up as always. Thank you, sir. John Lieber there of Eurasia Group. This from Politico. Over the last few days on Canada and Prime Minister Carney. The Canadian Prime Minister is spearheading discussions between the EU and a major Indo-Pacific trade bloc after calling on middle powers to join forces. Right to your point.
There has been a coalescing of other alliances in order to get around the U.S. influence, because the U.S., as the Munich report laid out, is now viewed as increasingly fickle and non-committed to this alliance. So, it's sort of a question of how this bears out in terms of trade, how this bears out in ultimate alliances, and whether this is longer lasting. But this was really prime reading. This Munich Security Report in 2026. I rarely read these types of communiques. I mean, this isn't exactly how I spend my weekends all the time. Sometimes, maybe more than I would like to admit.
Do you put the link into an LLM and just say, summarize for me in 100 words, or do you read the whole thing?
I read the whole thing.
Good.
No, I actually wanted to hear how they wrote it. It was important to understand how they wrote it and what was signed off on. It is pretty stark reading. I recommend it.
Standing ovation for Secretary Rubio.
Yeah, interestingly.
Very, very different to what we heard from the Vice President 12 months ago.
Was the content
different style?
Yeah, but was the content different? It was a different style, but was the content different? It was sort of interesting that way.
I'm clarifying very quickly. I'm right there with you. Up next, Kylie Cohu of Jefferies, as investors rush to Walmart ahead of earnings from New York City. You're watching Bloomberg TV. The opening about 2 hours away. Futures softer. We're down 1/3 on the S&P 500. On the Nasdaq, we're negative again. We're down by 0.7, coming off the back of the worst week of the year. On the S&P 500, the losses continue. In the bond market, new lows for the year on a 10-year bond yield, down another 2 basis points, just above 4%, 4.03 as things stand. As we count you down to the cash open, let's get you some single names, some morning movers. Danny Berger has more. Hey, Danny.
Hey, John. It's the deal that will forever be happening, and that is Netflix, Warner Brothers, and the most recent turn with Paramount. Warner Brothers reopening the conversations, the negotiations with Paramount, giving them a week to give their best and final offer. Apparently, they're willing to go up to $31. Currently, they're at $30 a share, but that might not be their best and final. So again, 7 days for that transaction to maybe take place. Paramount goes up 2.7%, Warner Brothers just under 3%. We've also had a lot of activist news this morning. I'll just go on one of them. Norwegian Cruise Lines, Elliott, reportedly by the Wall Street Journal, taking a more than 10% stake. It thinks that it can push this company to turn around its efforts and catch up to its rivals, which it has been lagging. It's also been working on adding a board seat to Norwegian Cruise Lines. Finally, some deals news. Hapag-Lloyd, the German shipping giant, will be buying Zim. This is an Israeli shipping company listed here in the U.S. This gives Hapag more exposure to Asia. $35 a share is what they will be buying it for, about a 50% premium. Shares go up 35%, trading just under $30. John?
Hey, Danny, thank you. Thanks for the update. More from Danny in the next hour. On our radar this morning, Anthropic's contract talks with the Pentagon hitting a snag over additional protections for its Claude tool. The company wants to prevent the AI bot from being used for mass surveillance or developing autonomous weapons. Elsewhere, Iran and the US meeting for a second round of nuclear talks in Geneva today. Iranian officials willing to discuss their nuclear enrichment activities, but are pushing for the potential easing of American sanctions. And finally, new polling, finding more than half of Canadians are willing to buy an electric vehicle made in China. The Prime Minister, Mark Carney, reducing levies on Chinese EVs, allowing as many as 49,000 into Canada each year at a 6.1% tariff rate.
Just compare that to 2024, and this is an important reference point. We're seeing now more than half of Canadians okay with the idea of buying a cheaper EV. Doesn't really matter to them. In 2024, 61% of Canadians said they would be less likely to buy a Chinese electric vehicle than others, simply because they were worried about the origins of that vehicle, even if it were less expensive. Only 25% said it wouldn't make a difference. So clearly, the zeitgeist has shifted, the emotion has shifted in Canada, and that's resulting in what they're willing to buy. This really goes to a question. How much is the United States pushing former allies or erstwhile allies into the arms of some of their major antagonists simply because they're not necessarily as reliable in some of the tariff issues? And this, to me, is a real question. And I'm wondering how this is received in Washington, D.C.
It's a real question, and you're right to point it out. It's not just that the U.S. is losing Canada. It's who is losing Canada to. That Canada is cozying up with China. Now, we'll see how this works out for Prime Minister Mark Carney, but he's not going to stop there. Based on the reporting coming from Politico, and I mentioned it moments ago, and if you missed that, I'm happy to share it once again, that the Canadian Prime Minister is spearheading discussions between the EU and a major Indo-Pacific trade bloc after calling on middle powers to join forces. How much further can he push this?
You know, this ultimately is a question, and is President Trump overplaying or correctly playing his hand in terms of how much the U.S. is the major trading partner with Canada? At the same time, if Canada has become the punching bag for the United States, what are they supposed to do? Their economy has been flagging, their currency has been declining, their debt has been increasing, and a lot of people are seeing themselves out of work and in a worse position. People are angry, and they're looking to an alternative, and clearly they're not alone. We're seeing similar rhetoric coming out of the Munich Security Conference. How much does this actually result in long-lasting action does remain to be seen.
The talks around USMCA becoming more and more contentious by the week at the moment. Let's turn back to financial markets. Futures a bit softer. We're down 1/3. Investors looking for a safe haven, and they've been pouring into consumer staples. The sector outperforming tech and financials so far this year. Staples are at record highs. Amanda Mull of Bloomberg joins us now for more. Amanda, what is behind this massive drive into staples and into Walmart in particular?
Well, I think that as investors look around at some of the potential impacts for AI, especially on the software business, is they believe that perhaps these software products are more fungible than we previously thought. They're looking for opportunities to put money into consumer staples. Over the past year, we've seen consumer retailers be more consistent than perhaps expected, even as consumer prices rise. And retailers that are known for good deals and their value proposition are doing particularly well. Walmart has increased its market share, particularly with households earning over $100,000, and those are the biggest spenders in our economy.
Amanda Moe with the latest. Amanda, thank you. The earnings from Walmart come in later this week. Look out for that on Thursday. Jefferies raising its price target on the stock to $225 as the retailer prepares to report fourth quarter earnings later this week. Kylie Cohu of Jefferies joins us now for more. Kylie, good morning.
Hey, good morning. Thank
what
you
a
so much for
run
having me.
we've seen in that name. How unusual is it to see it with a 50 PE?
I mean, we've never seen it before, truthfully. I think what's really happening is we're seeing an influx of tech investors. So one of your previous guests was talking about how it's going to really be these top 100 companies. They're going to figure out how to really monetize AI. And we think that Walmart is best positioned to do this. Walmart's been leading retail for years upon years. I mean, we think about things that are simple as barcodes. Walmart was one of the first movers in those type of things. So we do expect them to continue to lead the way in how retail specifically will adopt AI and how that's going to really evolve their business model, both in terms of advertising as well as just data monetization.
So this is Lisa's point. And she's been raising this question repeatedly over the last week when we've seen this stock at all-time highs. Some people have characterized this as maybe just a distorted risk aversion trade. You think it might be something else?
I think it is. I think it is really a change in business model, what the P&L is doing itself, right? So Walmart, we're expecting, sales, EBIT to outpace sales by almost double. I mean, that's not really what you hear of in these retail type models, right? Normally it's, slight low single digit growth and then slight operating margin. What Walmart's able to do is really get back more gross profit dollars by having these different revenue streams that are helping drive its retail business, specifically gaining with that higher income customer above $100,000, getting share both in food and non-consumables.
Yeah, I mean, the idea that Walmart has gone into high-end consumer goods, has gone into entertainment with Walmart Plus, has gone into a more effective ad placement akin to what Meta is doing with respect to its AI and its data usage. I mean, I just wonder who its main competitor is anymore, who it's gaining market share from. Because people talk about Target, okay, well, we've gone past that. How about Amazon? Well, we might have gone past that. Is this now an entertainment company? Is this a data company? Or is this a retail company? Or is it getting a lot of market share from all three areas?
I think it's that all three areas, right? So what they're doing is they're not trying to be the next Amazon. They're not going to develop all these type of data centers and kind of get into the back end of all this. What they're going to do is they're going to be a forward-leading retailer that's going to partner with the best of the best, and it's going to find use cases for all these different AI cases. So really, what we're seeing is they're doing it all, but remaining true to their EDLP and remaining true to, the U.S. consumer and trying to keep prices low. All of that working together is doing really well. We're talking about multiples being stretched relative to Walmart's historical norms, but if we look at someone like a Costco, they're actually trading below peak Costco levels, and Costco's never really been a tech leader, right? Costco's just been a solid executor and has, gained market share consistently. So even with this tech bend and retail landscape, Walmart's valuation actually isn't looking as crazy as it might on its face.
If Walmart can get money from its streams of revenue of data, from its entertainment side of Walmart Plus, maybe acquire some more media properties to boost that effort, and then they can lower prices. What chance does a Target have? What chance does a mom and pop store have? I mean, aren't we seeing the disruption before our eyes in some ways in the retail sector? And couldn't that bifurcation become much more palpable as the year goes on?
Absolutely. I mean, we've seen this. It kind of started even more with the pandemic, and it's just continued to roll and roll and roll, especially as we're seeing, price increases from, CPG. They're trying to get margin. It's kind of this delicate balance, and really it's Walmart right now in the marketplace, in our view, that's saying, hey, we're not taking any more prices. and you're not going to either.
Do you cover Mattel?
I do,
and
yes.
Hasbro too, right?
I do,
Can we finish there and talk about pricing?
Of course.
Are we going to start to see high prices this year? There was a story in the Wall Street Journal in the last few days that a lot of people are quoting and citing and saying that this is the year that actually we will see high prices. If you've been waiting for the tariffs to be passed on, this might be it. Where are you on all of that?
So we did actually see quite a bit of pricing come through the toy space specifically, really in this Q4. Let's call it mid-single digits on some items. Other items, it was double digits. So really what they've done is played around with elasticities. And yes, what we're going to see is kind of this higher for longer prices on these toys. So they're still kind of playing around, and I think right now we're going to see what's kind of considered steady state, whereas before, we already had our 2025 lineup, and then they had to, react and change prices. What they're doing now is they now have toys that are designed for tariffs, and so there's going to be a little bit maybe stronger pricing on some of these. But overall, I don't expect it to be that much incremental in toys from what we saw over holiday.
Demand didn't fall off. What did you see? You mentioned elasticities. What happened with demand?
Demand wasn't that strong, truthfully. We're seeing kind of a little bit of that with Mattel and their stock price. They end up missing on the Q4 report. But it ultimately toys did grow in 2025. It was just more in those key categories, not what I'd consider to be broad-based strength.
Kylie, good to see you. Thank you. Kylie Cohu there of Jefferies. Two different stories there, one on pricing, the other on Walmart, connected, of course. But the Walmart story, to your point, you've been saying this for a while. It is a mistake in the minds of many, including Kylie's, that ultimately just to dismiss this as some kind of risk aversion distortion, that there's something more than just that going on with that name.
They're able to monetize a whole host of data, and they're able to capitalize on how big they are to negotiate different contracts. They have a bunch of different things going on. The key test for Walmart, in my mind, will be if they get to a place where, like the banks, they can start to see some of their headcount shrink. That's when it's going to start to get really spicy, and that's what I'm really curious about. But until then, I think that this is a story that has legs just simply because of all of the changes that have happened in terms of their business model.
That multiple is eye-catching, though, going into that earnings release.
Maybe it's just because they went to the NASDAQ and then people said, tech company.
Hey, maybe.
That's what they wanted.
Maybe. We'll see. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. SpaceX and xAI are competing in a secret Pentagon contest to produce voice-controlled autonomous drone swarming technology. Sources telling us here at Bloomberg the companies are among only a few selected to compete in the $100 million prize challenge. Meanwhile, Hyatt Hotels executive chairman Tom Pritzker is retiring from his position and won't stand for re-election. Pritzker citing his association with Jeffrey Epstein for his decision to step down. Pritzker says he deeply regrets his association with Epstein and Ghislaine Maxwell. And President Donald Trump warning the federal government won't cover any cost overruns on a $16 billion Hudson River Rail Tunnel project. The project, known as Gateway, would add train capacity between New Jersey and Manhattan by building a new tunnel and upgrading the existing North River Tunnel. The president offering meetings to ensure the project does not go above budget. That's Bloomberg Brief. John.
Yahara, thank you. Thanks for the update. Up next on the programme, driving the bid into bonds.
Inflation fears are overblown. We think that's part of the reason we've seen such a strong rally from the US. 4% 10-year and a front end moving towards 3 cuts. We can start to lighten up.
That conversation up next with Earl Davis of BMO. Live from New York City. You're watching Bloomberg Surveillance. Live from New York City, welcome back to the show. Equity futures on the S&P, negative by 0.4. An update on the price action this Tuesday morning. Lower again on the NASDAQ. Near session lows were down by 0.8%. In the bond market, here's a headline for you. Lows of the year. The 10-year down 2 basis points, 4.02%. Under surveillance this morning, driving the bid into bonds.
The market's kind of ahead of the Fed dots, given everything that we know today and the fact that the growth is likely to be front-loaded because of the one big beautiful bill and the rate cuts are likely to be back-loaded. Yeah, we just think at 4% 10-year and a front end moving towards 3 cuts, we can start to lighten up. Ultimately, we think the inflation fears are overblown. We think that's part of the reason we've seen such a strong rally from the US.
So here's the latest this morning. Bond yields heading to the lows of the year. Cooler than expected inflation. Raising bets the Federal Reserve will deliver more interest rate cuts through the year. Earl Davis of BMO writing, we believe that yields will remain in the 2025 range and growth will continue to surprise to the upside. Earl joins us now for more. Earl, welcome back to the programme. Let's get the update from you. I know you're bullish on the outlook. What are yields doing down at 4% on 10s?
Well, I'll start by saying I love the smell of napalm in the morning. Meaning, this risk off, this fear is providing us with opportunities as active managers to position for the medium to long term. So as you put on the screen, our view was 10-year bonds will stay in a range of 390 to 480 in 2026, midpoint 435. As we approach 390, we go more and more underweight. Can it go past 390? Yeah, sure. It could go to 375 if you have military action in Iran or an acceleration of the AI fear. Having said that, when it gets to that level, it's like being in a doctor's office, getting the rubber hammer on the knee. Will the knee stay up? No. And the only thing that will make the knee stay up is QE, and you're not going to get QE at bond lows. You'll get QE at bond yield highs. So we like going underweight duration there.
So what is it about 390 that makes it difficult to sustain life at those levels?
Well, there's a few things, as you get further out the curve, 10-year bonds, 30-year bonds, and I'll come back to that in a second, there's less and less influence of the U.S. on yields. It becomes more global influence the longer maturity you have. And the weight on global yields is Japan. Japan, the largest buyer of international bonds. As their yields go higher, it's a substitute, not for international buyers, for Japanese buyers, which means you have to find a price level that sustains or that new people want to come into the market. And we don't believe it's 390 to 375. So that's the magic thing there. Coming back to your point, even though that's our trigger level, 390 to 375, we're actually going underweight the 30-year bond because there's so much duration risk and there's so much more international influence on that part of the yield curve.
Torsten Slot just put out a note minutes ago talking about how 90% of the global bond market, the public bond market, is trading below a 5% yield. At a time when people are starting to worry about inflation being persistent, I just wonder, can you fight this? Do you understand it in terms of why people are going so much into bonds if this fear of inflation has been persistent for years?
Very easy answer to that. The answer is 5% still above inflation, which means you're getting a real yield of, call it 1.5% to 2% right now, which means if you invest the bonds in 10 years, that real yield, like a TIPS or whatever, you're going to realize that. So that gives you a little bit of margin of safety. Why people are still buying bonds at these levels is because it's 150 basis points to 200 basis points over inflation.
Is your bet, Earl, that the growth portrait of the United States and more broadly is much higher than people are currently expecting? So you want to be in risk assets and you want to be underweight duration. Is it fair to characterize it in that kind of way?
I would say there's a number of people who anticipate growth. We anticipate it for longer than the market's anticipating. And that's because we haven't seen the flow through of retail spending from the tax refunds. There's significant amount of tax refunds going to the lower and middle income class in February, March, and April. They have a lower and middle income classes have a higher propensity to spend a higher amount of those tax receipts. So we do expect to see some growth surprises based off the tax receipts over the next 3 months, which again, buoys are a reason for going underweight duration. And I'll come back to going overweight credit now. We especially like credit because the spreads are widening, and they should widen with all this supply coming through this year. So it makes us much more comfortable going overweight credit at wider spreads.
So Earl, I just want to get to the bull thesis on the economy, and it kind of connects to what you're talking about in credit, and it's the risk factors. You noted one, you alluded to it. One was geopolitics and the prospect of military confrontation. The other was an AI meltdown, and I think that's how you phrased it coming into 26. Yep. What is an AI meltdown, and does it look like this?
Yeah, this is how the start of it would look. We don't think it'll be an AI meltdown, but the AI meltdown comes from, can the revenues being generated by future AI support the spend right now? We've seen a little bit of a shift in regards to it's not going to be all bonds. We saw that with Oracle, where they're issuing more equity. As a bondholder, that makes us more comfortable buying those bonds. And to speak of Oracle, for example, those bonds trade about 200 basis points over 30-year bonds. we're comfortable with that. They also trade 100 basis points over Meta, equivalent to AI bonds. So we believe that whole spread complex is going to go higher, which we were underweighted last year. We're starting to buy into AI now because we don't believe this fear is going to be sustainable.
How insulated do you think that part of the market is from some of the software fears that have really started to bubble up over the past few weeks?
It's a great question. I would, how we look at it, it's not how insulated is it over the period of the bonds right now. We believe it's insulated for 2026. We believe spreads could widen further because there's a lot of issuance coming. But a lot of these companies that we're investing in still have a revenue producer. So that's what makes us comfortable. Where it gets risky is once the expectation of spend is over revenues, and we don't expect that to fully change. Maybe it narrows a bit, but we don't expect that to fully change, at least not for this year and for next year, which makes us comfortable owning these bonds at wider spreads. We feel we're starting to get rewarded for the risk involved in owning those bonds.
Are you getting rewarded yet, Earl, for owning the risk involved with lower rated bonds and loans, for that matter, that are more leveraged to, say, software sectors that are at risk of being disrupted?
So great question. It totally falls into our strategy. Right now, we're 1/3 overweight. So if we have 3 risky units, we're at 1/3 overweight, 1 risk unit. It's all in IG right now. We don't feel that we're adequately rewarded for, call it high yield bonds at this point in time. We do like it because the underlying growth dynamics are supportive there. The spreads are too tight. So our 2/3 risk unit, if we get further weakness, will go in IG, but the last unit goes in high yield, and we'll start switching some of our investment grade bonds to high yield. Once we feel we're at a spread level that's adequately rewarding us, we're probably about 100 to 150 basis points away on high yield.
Oh, good to see you. As always, thank you, sir. Earl Davis there of BMO, breaking down his views on the sovereign and corporate debt markets. Jim Karen of Morgan Stanley caught up with us at the back end of last week. He said this about contagion risk. A lot of those bigger risks were diversified into the private markets, so the ability for this to create contagion and become a financial event, a bigger financial event, is relatively low. And you're speaking directly to the software concerns people have.
Yeah, and a lot of people have argued that, if anything, private credit actually is a buffer to a lot of market risk because some of the higher leveraged loans were over there. That said, if you take a look at U.S. tech-focused leveraged loans, you can see the distress level rising to 15% of all loans in that book. So clearly there is a public market that is feeling some of this distress. And I would argue that not all public markets are really invested concretely in some of this stuff. It's not like we can isolate and sort of ring fence all of the toxic debt in one place or another. The question is where the pockets are going to emerge, and are they going to be in public or private?
His point on treasuries was interesting.
Yes.
Something to think about, at least. You've got the risk aversion trade driving yields lower, down to 4% on 10s. But to sustain life around 375 to 390, he believes is difficult because the foreign buyer is going to step back away. And we've got a lot of supply to clear over the next year, I guess.
A lot of people would agree with him. What I'm not understanding right now is, based on the fact that the consensus trade right now on Wall Street, according to the Bank of America Fund Manager Survey, is a steepening yield curve. And is this idea that the long end of the yield curve is going to continue to rise and inflation fears haven't gone away. My question is, why is that not working? Why is that violently being disagreed with in markets? Why is that JP Morgan Asset Management comes in and says we're buying hand over fist? Because ultimately people have gotten ahead of their skis. Is this a trade? Is this Japan? That's what I'm really trying to wrap my head around.
30s are now where people thought 10s would be. Things have changed pretty quickly. 466 on 30s and 10s, just north of 4%.
Maybe it's the Fed Treasury Accord. They're going to get together. They're going to do yield curve control under a different
lot about
name.
that, and then everyone's got a different description of it.
I heard 5 different takes on it this weekend, and there were about 6 different ideas in there.
A lot of speculation about the future of this Federal Reserve and the kind of relationship it'll have with the Treasury. Coming up next, Ed Yardeni of Yardeni Research, Ed Ludlow of Bloomberg News, Stephanie Roth of Wolfe Research, Krishna Memani of Lafayette College, the third hour of Bloomberg Surveillance, just around the corner.
There's a lot of creative destruction that's taking place in markets.
Some of these things are overdone. It's about valuation.
The stress within the AI and the software names is still very, very concentrated.
There are going to be losers and winners all over the place.
It's that unknowing that makes people much quicker to pull the trigger.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your scores look like this. Check it out. Equities negative by 0.5% on the S&P, down by 0.9 on the Nasdaq. In the bond market, money rushing into bonds, yields lower across the curve. We're down by 2 on 10s to 4.03%, down by more than that on 30s to 467. So what's happening? This is super defensive. Risk aversion dominated the market over the last week. This is not just the rotation of the previous few weeks where we were talking about going into financials, banks, small caps. Things changed last week and became much more defensive. And the bond market move speaks to some of that.
What we got from the labor market wasn't necessarily definitive one way or another in terms of the strength of the existing U.S. employment backdrop. At the same time, what everybody could agree on when they looked into the internals is that this did not show evidence of an accelerating labor market. This didn't show signs of some sort of reacceleration that most investors had priced in as their base case heading into 2026. So it's important to understand the positioning coming into this year. And then what we're getting from the data, which is downside surprises in a sense that maybe things really aren't taking off and broadening out in the way that some people would like to see.
Earlier in the program, we played some sound from James Athey. James Athey, an old friend of this program. He said something a few years ago. He talked about narrative ping pong. Remember narrative table tennis? Yep. That's what it feels like over the last several weeks or so. Everyone's super bullish on the rotation, then things become super, super defensive. Think about how quickly the narrative has changed around CapEx. We've had decades, literally decades, of investors telling companies they've not been investing enough. And then just like that, fund manager survey, Bank of America, investors saying corporations are over-investing. That's at a new record high.
They're talking to a number of the hyperscalers that just announced $650 billion of CapEx this year. And it's not just the overall scale of that. It's the pace of increase year over year, 100% increases that you're seeing. And this question of what is it going to that's actually going to be productive? Are we just trying to create bots for ourselves to replicate humanity? Or is this going to go toward creating some sort of better future for all of us? I mean, not to get existential, but the tail risks right now have never been fatter. And the uncertainty right now has never been greater. That's what a lot of people are saying at a time where valuations are very high. So people are selling. And it's the reason why I do wonder how much the sell America trade and go into other countries is right now sell uncertainty and go to something that's less high priced because guess what? It's got to be a better bet. And how much is that what's underpinning a lot of this trade?
Well, to that point, sell America, the bonds don't work. Remember that? The bonds don't work.
I think I vaguely remember that.
Yields at 4% on 10s. The bonds look like they work.
Yeah.
Now, maybe that's going to change. I don't know. But that Sun America trade was only a month ago.
Yeah. But is that because of some policy or is that thank you, Bank of Japan? Thank you, Sanai Takaichi. I mean,
Fair.
Again, talking about the confusion of the swirling trends when you get to the long end of the yield curve, this is determined as much by international factors as it is by domestic ones at a time where no one can agree who the real Kevin Warsh really is. So it really speaks to a moment of ultimate churn.
Yields down by 2 basis points. The narrative table tennis continues back and forth, week to week. Day to day. Coming up, Ed Yardeni of Yardeni Research with stocks adding to losses. Stephanie Roth of Wolfe Research looking ahead to the inflation data later this week. And Krishna Memani of Lafayette College breaking down the shift in market leadership. We begin this out with stocks edging lower as AI concerns weigh on Wall Street. Ed Yardeni of Yardeni Research remains bullish. He writes the following. Investors are rotating among sectors of the stock market rather than moving from stocks to cash. The bull market should remain strong as it broadens. Ed joins us now for more. Ed joins us now for more. And Ed, I've got to pick up on the question that Lisa and I were talking about. Ed, sure. The rotation, is it more than just that now? Is it becoming just a little bit more defensive?
Well, I think, if you played day by day, it certainly felt like it last week, as you said. I think some of this is just AI fatigue. People are just totally tired of the AI concept. They don't know whether they're coming or going with it. They don't know whether it's going to be wildly profitable or not. And I think another thing that's entered here is, Elon Musk has been talking about how deflationary the combination of AI and robotics is going to be. And so we've got all that happening. And as you folks were saying, the geopolitical situation is also quite volatile. We've got a situation in Japan where the government wants to stimulate and have a larger deficit, and yet the Bank of Japan is tightening. And then, by the way, let's not forget there's a possibility here of a war between the United States and Iran, and that could obviously push oil prices higher. But the bond market's kind of taking it as maybe it's time to look for a safe haven from all these various concerns.
So, Ed, let's talk about the havens and where we're fleeing. So the money is leaving tech. The Nasdaq's down by about 1% this morning. The money is going into staples, into utilities. Those two sectors are all-time highs.
Right.
Where do you think the bigger risk is at the moment? Where people are leaving or where they're going to?
Well, at this point, I think the uncertainty in AI suggests that entire trade is going to remain challenging. And meanwhile, I think investors will continue to go basically from the virtual theme to the physical theme. They're getting confused with all the digital technology, and they're going back to the old-fashioned analog world, the physical world, and that means materials and energy, and as you said, consumer staples. I think financials is one area where it's getting overdone. I think they're clearly the large banks and even the regional banks are going to do just fine in this environment. And I think healthcare, which was a laggard last year, is also an area that's going to clearly benefit from AI technology. I don't see a situation where AI robots do surgery, though. Elon Musk has been talking about that as well.
Is there a contradiction, Ed, in the idea of materials, metals, commodities, the idea of the physical world continuing to gain favor, and also liking government bonds that are somehow implying inflation remains subdued?
Well, I think, Lisa, the thing that's important to recognize is things do change. And in our world, their wealth has increased rather dramatically. There's a lot of wealth that needs to be, that creates investment demand. And a lot of it does want to be diversified. And so it's perverse. As the stock market's gone up, people have felt a little bit more anxious about it and said, well, maybe it's time to rebalance. So that's why I recommended rebalancing in early December of last year. I actually said it's time to underweight the Magnificent Seven because I felt that there was just too much uncertainty related to their capital spending, their rate of return, the arms race that they were engaging in. And I did, for the first time in many years, suggest maybe it's time to look overseas. Maybe there's, I don't know, safe havens, but there's cheaper havens overseas. And that worked out very well last year. I only jumped onto it in December, but I think it's going to continue to jump to do well.
Are international stocks a better diversifier than U.S. bonds?
Well, I'm not going to answer your question with either or. I think gold has been the really good diversifier for the stock market. If you put the S&P 500 on the same chart as the price of gold, same scale, you'll see that they're inversely related on a cyclical basis. So it's really gold is a very good diversifier. It's inversely correlated with stocks, but the trends are the same. So if I'm right, and we're still very much in a bull market in stocks, just rebalancing diversification is going to benefit gold. But I think it's also, we're seeing here, it's benefiting bonds and it's benefiting emerging markets. Look, the MSCI US got to be 65% of the market cap of the global MSCI. And that's, it's hard to overweight something that's already so overweight. And so that's a good reason for diversifying globally. And a similar story can be told about information technology and communication services. They got to 45% of the market cap of the S&P 500. And maybe that's it for a while. And we are seeing rebalancing. So I think the rebalancing trade is a sensible one. I would stick with it.
So, Ed, what's the argument for the index, for the S&P, for the market cap S&P 500? What's the bull case?
Earnings have been phenomenal. And they're going to be at a, when all the data comes in for the fourth quarter earnings reporting season, it's going to be at an all-time record high. I thought that we're going to get something like $310 a share for the S&P 500 this year, but the analysts are already up to about almost $320 a share. And then for next year, I thought $350, and the analysts are already talking about $360. So the analysts are getting pretty whipped up about the outlook for earnings. And it's not just technology, which I think will continue to be a very profitable area, notwithstanding the concerns about return on capital. But it's broader than that. And not only that, but I think the fact that revenues of the S&P 500 are all-time record high speaks to the fact that the global economy is doing remarkably well. I mean, it's really quite quite amazing given the stress tests that the global economy had with the tariffs last year.
Ed, you nailed it when you called this the roaring 2020s. We're already in 2026. Does it still feel like the roaring 20s to you, or does it feel like it's kind of entering its later stages?
Well, I don't think so. I'm already starting to think that, if this works out, I'll talk about the roaring 2030s. The 2030s is going to be a little bit tougher because the 1930s were really just plain ugly. But let's stay on the decade that we have right now. And as you said, we've got a few more years into the roaring 2020s. I don't think that it's showing signs of fatigue. I think the roaring 2020s is still very much intact. We've got the economy doing extremely well, real GDP all-time record high, consumption spending all-time record high, capital spending all-time record high. Stock market not too long ago was at an all-time record high, and I think now is just a pullback. So I think it's still very much the roaring 2020s, and it's earnings led, which is a good way to keep it going. If it was all valuation, I'd be concerned, but I think the fact that earnings are validating this bull market, that's a good thing.
We're fatigued, Ed. Even if your thesis isn't, we are. Ed, thank you, sir. Ed Yardeni of Yardeni Research. I can't get past Q1, never mind the 2030s.
I don't think I can get past last week, let alone the year. I mean, truthfully, it feels like in terms of narrative ping pong, it's been relentless. And everyone who comes in is like, oh, are we done yet with this year? I mean, that's pretty much every guest.
It's pretty exhausting stuff. We're down another 0.6% on the S&P 500. The opening about 1 hour and 18 minutes away. Let's get you an update on stories worldwide with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. Apple is revamping its podcast platform as interest grows in incorporating visual elements. The company aiming to make it easier for audiences to shift between viewing a video podcast and listening to audio only as the industry shifts toward video. For example, YouTube is the #1 podcast consumption platform in the U.S., according to Edison Research. Meanwhile, Paramount shares are rising in the pre-market. Warner Brothers has agreed to return to the negotiating table for 7 days to iron out the details of Paramount's most recent offer, which was reportedly raised to $31 per share. Despite returning to the table, Warner Brothers says its shareholders still unanimously recommend sticking with its binding agreement with Netflix. And activist investor Elliott Management is building a more than 10% stake in Norwegian Cruise Line. That's according to the Wall Street Journal, and it's planning to push for changes at the struggling cruise ship operator. The company has lagged behind competitors, including Royal Caribbean and Carnival, and Elliott believes Norwegian could make changes to catch up to those rivals. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next, the morning calls, plus Bloomberg's Ed Ludlow, with futures pointing to another tech-driven sell-off for Wall Street. The Nasdaq down by more than 1%. Live from New York City this morning. Good morning.
Rather than applaud these $120 billion CapEx announcements from the hyperscalers, the market actually punished them. So to my mind, this rotation and this odd coupling of cyclicals and defensives, more about a change in sentiment, more about a rotation out of tech, and less about an economic view.
That's a really, really important debate. That was Russ Koesterich of BlackRock coming out of last week. And when you come out of last week and you break down the sector performance, and banks have just had their worst week since Liberation Day week, since April of last year. And on top of that, you've got utilities and staples at all-time highs. It's pretty easy to conclude, it usually is, that there's some economic stress starting to emerge. But then you look at the data of last week and the week before, the ISM manufacturing picking up, jobs gains, the best we've seen in more than a year. Something's not adding up with the sector price action and the data we're seeing elsewhere.
Yeah, especially because you do see some positive data. You do see some negative data with JOLTS coming in lighter than expected, in a sense that maybe openings are coming in, and certainly sentiment has been in the gutter for a while. But it does seem like something has shifted. Is this just a momentum trade turned on its head, or is this something fundamental that will cause the Fed to cut rates significantly and will lead to this rally in bonds continuing?
Is it risk appetite, or does it tell you something about the economy? This picture, equity futures down again by 0.5. on the S&P, down by 1% on the Nasdaq, and bond yields are the lows of the year. The bond yield move doesn't help Russ's case this morning, with yields at the lows of the year just north of 4%.
If you're taking any kind of influence just simply from the bond yield itself, if you take a look and consider the fact that two-year yields are almost where they were in 2022, it does look like a Fed that has a reason to cut and cut more significantly than the market had really been set up for.
340 at the front end of the curve, yields just about unchanged on the session so far. That's the price action. Let's get you some morning calls. First up, Rothschild & Co. Redburn downgrading Warner Brothers Discovery. The firm believing Netflix is the most likely winner and that there will not be materially higher bids coming out of Paramount. Elsewhere, Melius upgrading Chevron to buy, with the firm citing cash generation, Venezuela upside and data center demand as growth drivers. And finally, Mizuho cutting its price target on CrowdStrike, saying, quote, sentiment across software is nothing short of horrible at the moment. Then it's a bit of a catch up there. CrowdStrike down by 1.6%. You don't say.
Yeah.
It's been awful.
Although CrowdStrike was on the list of potential beneficiaries of, did you see that Goldman Sachs index of the losers and the winners from the AI disruptions? They were on the winners, but I don't think it's catching on.
No, not this morning at least. We're down by 1.6%. Let's stick with tech. NASDAQ futures session lows down following 3 straight weeks of losses. Investors showing concerns the AI-fueled sell-off is deepening. Bloomberg's Ed Ludlow has more. Ed, welcome to the programme. You and the team have been tracking this for a while. We've been covering it from a sentiment perspective. Yeah. You cover the product. Is the product really under siege, under threat? Can these moats hold up?
Well, the product under siege, under threat is evidenced by revenue gains, right? And the market's kind of come back from the holiday weekend with the same anxiety that it went into it, which is the AI contradiction. AI will transform the old economy and the new economy being software. And at the same time, we're worried if we have an AI bubble, largely based on capital expenditure figures from the hyperscalers. And like the question that your guests try to answer is very difficult is, can both of those things be true at once? And depending on which side of the bed you wake up on, this morning the market seems to be trading on the AI bubble part of that equation.
Well, Ed, this is the problem. Momei Qu is on the programme, and she called it the great contradiction. That how can we sit here, like you say that this will disrupt and kill so much, and at the same time the capex is the waste of money. And on the capex, it's interesting that the money's going to be spent, and you'd think the traditional beneficiary of that would be NVIDIA. And NVIDIA's traded softer, Ed, for the past 2 weeks. Now, we've been asking the question, what gives? What gives?
The problem is this week nothing will happen, and then NVIDIA will post earnings next Wednesday. And so, with the capital expenditures number, the consideration of it, with NVIDIA, yes, being absolutely the main beneficiary is, it's easy to say, OK, we don't know how we feel about $600 billion combined across the hyperscalers and Meta. But go a layer under that, and now people are starting to look at the impact of capital expenditures on cash flow. Historically, CapEx as proportion is 40% of what's really strong cash flow. Now, people either do or don't care if a name like Amazon swings into negative free cash flow, which could definitely happen this year, given the commitment that it has to capital expenditures. Basically, cash flow is being wiped out. So, yes, you wait for NVIDIA, but NVIDIA being the main beneficiary of the capital expenditure anyway, the run-up in all of those stocks over the last, from the ChatGPT boom in 2022 until the beginning of this year, was based on real revenues growth. And so you can imagine the situation, John, well, what if we get to Wednesday and NVIDIA doesn't sort of give us that real growth, at least looking forward, that they have done in prior quarters? It would be a bit of a disaster.
That's the hardware side of things. On the software side of things, there's a real question of what capabilities actually are coming out of some of these large language models. And then you had Microsoft's AI boss coming out a couple days ago and saying that he could see AI and some related technology replacing most of white-collar jobs within 12 to 18 months. How do you view that? I mean, John and I were talking about, is this just a marketing ploy? Is that how you see it too, Ed, or do you see actual tangible gains in the technology behind this?
I think through the lens of the show, particularly with people that are either on the private markets venture capital side and are trying to grow a new generation of companies that want to do the same thing, sell software that disrupts legacy software, people don't see it as imminent as that. Corporate America still has to buy software from other software names. And so there's a second contradiction within that. If you go back to earlier in the earnings quarter when you had companies like Salesforce and ServiceNow, they actually showed not just good growth, but a backlog of demand for agentic AI, things like that. Those are also tools that are under direct threat from what OpenAI and Anthropic want to do through their own models. That they are basically packaging up software and selling it either through an on-demand or through a subscription basis, and showing real evidence that people are willing to pay for it still, even if there is a freer or less expensive option from one of the frontier labs. But the market didn't give them any credit for that.
It seems like right now Wall Street's very worried, and Wall Street has been more worried than San Francisco for quite a while. And I just wonder how Silicon Valley is viewing Wall Street's concerns right now. Is there sort of a sense that they just don't get it? Or is there a sense in Silicon Valley that something has shifted in terms of the development and the allocation of some of this technology?
Yeah, the way that I pose that question to the private market investors who want to find the next Salesforce or ServiceNow or a company that plans to do what lots of people are already doing is, where is the opportunity? And the answer that we always get back is it's in specialism, right? So one of the really weird things of the market in recent weeks was the use of generative AI tools or agentic AI in the legal context. Well, actually, there are loads of specialist software names that have been doing that for a long time. And there's a new generation of AI labs that only work on models for review of legal texts and legal rationale, reviewing legal precedent. Those things are both happening in parallel. So the response of those people would be like, yeah, we believe that they will disrupt a market that isn't yet being disrupted fully anyway by Anthropic or by OpenAI.
Without a doubt, Ed, this is the economic story in many ways of the moment.
Yeah.
You'll be catching up with Mary Daly of the San Francisco Fed. What does this mean for jobs, for payrolls? Ed, it's got to be the #1 question for this Federal Reserve over the next 12 months and maybe much further beyond.
Yeah, I mean, there are many newly minted AI millionaires, right? I think one thing that it will come back to is a definition of productivity, right? I wasn't around then, but in the late 90s, Alan Greenspan in the dot-com era identified productivity having an impact on economic growth. And in that era, you know, pick up a history book, that the Fed held off with rates in that context, raising rates, because it believed that productivity-driven gains in the economy could happen without any sort of big swing in inflation. Now the kind of opposite is true, right? Is that, do you see tangible impact on productivity? In other words, making existing jobs better, or do you see job displacement? And how will that affect monetary policy going forward? If there will be productivity-driven gains in the economy without necessarily the inflation that comes with it. And again, go back to what's happening in AI, in real estate in this city in Silicon Valley, in stock-based compensation, the people flooding into San Francisco and buying up what little housing there is. All of those little things within the 12th district will matter probably. And so I'm interested to hear what President Daly has to say.
I'm guessing Ed was around. He was just interested in different things back in the 90s, just to confirm.
Yeah, probably there were.
Ed looks young, it's just not that young.
It wasn't like he was born in 2010.
Ed Ludlow there with the latest. Up next on the programme, Stephanie Roth of Wolfe Research looking ahead to inflation data later this week with equities at session lows from New York City. You're watching Bloomberg TV. Three weeks of losses on the Nasdaq, and the losses continue. We're down again this morning on the Nasdaq 100 negative, softer by 0.8% on the S&P 500, struggling to get off the mat. The S&P 500 negative by 0.4%. The opening bound 1 hour away. With your morning movers, Danny Hasmore. Hey, Danny.
Hey, John. We start with some deal news. Danaher, the medical company, is going to be buying Masimo, a med tech company, for $180 a share. So we're just under that at the moment. Masimo makes med tech. You'll remember them. They actually were in a legal fight with Apple over their blood oxygen monitoring technology, which Masimo said was a patent infringement. Danaher shares fall 6% after that deal announcement. Elsewhere this morning, we are looking at another day in a twist and the turn of the Warner Brothers Discovery deal, reopening talks with Paramount for 7 days. So Paramount has 7 days to make their best and final offer. The current reporting suggests they could go up by $1 a share to $31 a share, but that might not be their best and final. So will they go with them? Will they stick with Netflix? Warner Brothers saying that the board's still recommending that they go with the Netflix deal. Finally, rounding things out, many reports, I should say, this morning of activist investing. So just a few of them. Norwegian Elliott taking a more than 10% stake in that company, shares up nearly 6%. Fiserv, this one's coming from Jana Partners, those shares up 3%. And finally, TripAdvisor, Starboard taking a stake in TripAdvisor. It's a mix between the various activists pushing them to improve or outright looking for sales, but all those shares rallying off the back of that. John.
Danny, thank you. Looking forward to your coverage alongside Matt Miller in about 30 minutes' time. Going into the opening bell, 60 minutes away. Turning to the economy, PCE data and the latest Fed minutes on deck this week. Mike Qu joins us now for more. Morning, Mike.
Good morning, John. Let me throw an idea at you. You guys have been talking about if the Fed's going to cut rates again. What if the economy is improving enough that they have to consider raising rates this year? The Empire number just out, 7.1. That is down from 7.7, but still shows expansion, and it's better than the 6.2 that was expected. And just a short time ago, we got the ADP weekly numbers, and I know there's a lot of qualifications for that, but let me just point out that ADP found 10,250 jobs average creation during the last 4 weeks, then revised last week's up to 7,750. So it does look like there's still some strength there. Remember, we got that strong jobs report. Now, coming up the rest of this week, durable goods orders. Be interesting to see if business is still spending. The expectation is they are because of the AI data centers. We get housing starts and Fed minutes. That's going to be kind of stale data. I'm not sure Fed minutes will tell us much because it's 3 weeks ago, and we are seeing these slow signs of maybe the economy getting a little bit better. Thursday, December trade, important because we also are going to get next week the fourth quarter GDP. December trade, pretty much the last number you need, and we'll see whether we come in above 3% or even closer to 4%. And then, of course, on Friday, the PCE numbers, income and spending. PCE is what the Fed follows. CPI has fallen, but economists think that PCE may move up. It's a December number, not a January number like CPI, but it would make it optically hard for the Fed to be talking about cutting rates if it's at 3%.
So, Mike, let's talk about hikes. You went there. Torsten Slock of Apollo posed the question as well. In fact, he thinks we will be talking about rate hikes at the end of this year and not rate cuts. So, Mike, I'd throw it back at you. The question we've got to try and answer is whether the Kevin Walsh Fed will be guided by data or guided by politics. And I'm not sure many people know the answer to that just yet.
Well, I think that people are worried that it could be guided by politics because, of course, Donald Trump. But Walsh is a Fed institutionalist, and he's probably going to have a limited amount of influence at the beginning of his term since he's just coming in the door. So it's probably going to be more the data. And if the data continue to look like this, they'll certainly be on hold. And the idea will be, do we see growth picking up and real rates rising, which might require a response from the Fed?
Mike Qu with the latest down in Washington. Mike, thank you. It is not the consensus view. Let's be very clear. I don't think I can think of a single person whose base case it is that will get hikes this year. But there is a question to be asked, isn't there? Can you imagine, it's almost unthinkable, that Kevin Walsh, going through this whole interview process with the president, would hike interest rates later this year?
Well, this is the reason why nobody's betting on it. Even Torsten Slock says that going into 2027, it's maybe the time to actually execute on something like that. But later this year, there might be a discussion around this. It does seem unthinkable. That said, if you keep pointing to the data as showing strength, you can point to the data and show anything you want. I mean, you got Andrew Hollenhorst out this morning talking about 130,000 jobs. Looks great. 4.3% unemployment rate. And then he goes into all the reasons why this actually isn't as good as it looks. So you can look at the data and you can come up with very different conclusions. And that's what we're hearing from Wall Street analysts across.
You sound super excited about the debate for the year ahead.
Well, it's just, you can make an argument on either side, and I will nod along with you, and I will agree. I just don't know which is right.
Stephanie Roth of Wolfe Research writes the following. Last week's data does not give the Powell-led Fed a reason to cut. We're tracking core PCE at 0.32% month over month, roughly where we expect it to remain through the first half of this year. Stephanie joins us now for more. Stephanie, good morning.
Good morning.
So the Chair Powell Fed is done. You've said that a few times. Where does it leave the Walsh Fed later this year?
I think the conversation around hikes is probably not something that's going to happen. So it's going to be a question of whether he can get cuts done. We think he probably will, but it will be a tough call, especially at the beginning. In the first couple meetings, inflation's going to be running at 3% year over year, and growth is going to be pretty good. So it's going to be very difficult for him to cut right away. Now, later in the year, we should start to see inflation cooling again, talking about inflation that's sequentially starting to look more like a 2% run rate. in which case you'll probably see them be able to actually get a couple cuts done.
So,
but
Stephanie, that's the question, I think, the important one. What's going to give them the space to move? Is it the labour market data that gives them a reason? Ultimately, the data's too weak, or the inflation data that gives them the space to reduce interest rates? You've got a bias on either side of the dual mandate at the moment?
I think it's going to be more inflation giving them the space, and they still want to get a couple cuts done. The labor market will probably just fine. We're talking about the unemployment rate remaining roughly where it is, and perhaps taking down a little bit in the next couple months, and then kind of remaining around 4.2, 4.3 for the bulk of the year.
Does it matter where the inflation is coming from? Let's say we do get a 3% core PCE, but it's not being driven by wage gains. And we've seen that wage gains have cooled. We saw the ECI coming in lighter than expected in last week's data. I just wonder if you have Fed officials, including the likes of Mary Daly, who's going to be interviewed on Bloomberg TV by Ed later today, who's talking about structural scarring during times of technological transition. Couldn't people dismiss that type of inflation as not as sticky as if it were coming from something more like wages?
I think that's fair, although if inflation's actually running at 3%, you kind of have to ignore where it's coming from. Later this year, once you actually start to get some deceleration in parts of the parts of the inflation basket that are tied to tariffs, then that gives more of that space for the Fed to be able to cut, and also to be able to discern where the inflation is coming from. When you're actually sitting here with 3% inflation, you can't really pick apart the data.
Are you frustrated by this, that we get data and that two people will tell two completely different stories, and that you could say, yeah, 130,000 looks good, and someone will say, no, it's not, you're just totally wrong, and you've got that for pretty much every single data point that you have coming out, and then you've got someone who comes out and says, can you trust it anyway? I mean, isn't this a bit frustrating for you?
Yes, it's frustrating, but you often have that in January.
Sounds like it's more frustrating for you than it is for Stephanie.
I'm trying to
But I'm pleased she's sort of like, was that a cathartic moment for you?
Well, it's just very difficult to know even what we're talking about when people question every aspect of it. And they're just coming through the nose. Carry on, please.
So when we get data like this, it's helpful to really take a step back and look at what is seasonal, what is changes to methodology. When we do all of that, then it's easier to see a clearer picture. And our sense is that the jobs number, 130,000, was overstated to some extent by birth death. So the adjustments to the model, probably about 50,000. So we'd strip out about 50,000 from the number. There's also some seasonal impact. So our sense is that labor market is running at around 75,000 a month, which is a decent place, kind of in line with where the supply is. So that should keep the unemployment rate steady. The unemployment rate has been driven by the government shutdown, by seasonal issues. So when you smooth through all of that, you can see a decent picture where the economy's fine, the labor market is not stressed, nor is it overheating. And that's a decent place. It's kind of a Goldilocks position at this point.
Do you see that confirmed by other data points elsewhere? Soft data or hard data?
Yeah, I mean, unemployment claims are a nice place to start. They haven't been rising. You don't see the jolt openings. Did look kind of soft. Quits rates look kind of fine. You're not really seeing a big rise in layoffs from that perspective. I would dismiss the challenger data that a lot of people gave attention to. So when you look at the broad set of labor market indicators, then when you match that with spending, which looks fine, the labor market kind of is consistent with all of that.
Just out of interest, why would you dismiss the challenger data? What about it would you dismiss?
Well, one, they're looking at headline announcements. And, for example, UPS had a similar announcement last year, and they did a lot of those layoffs through attrition. We knew that Amazon had made these announcements a number of times. They employ a large number of people. So, 30,000 people here and there doesn't compare to their workforce that's, over 1 million. So when you look at the layoff numbers, they're not actually that scary. January, you often have layoffs. That's a seasonal time where companies tend to do layoffs. So even if you look at, on a year-over-year basis, it's kind of hard to look at it that way. But it's a period of time where January you often get big layoff announcements, and that spooks the labor market, that spooks people concerned, forecasting the economy, and then it tends to go away in future months.
This has been a very refreshing conversation. We haven't mentioned AI once. We haven't talked about, the Armageddon of the white-collar worker class and how that's going to lead to some sort of civil war. I'm just wondering, from your perspective, do you just ignore all of the discussion? Do you ignore Microsoft's warning that AI is going to eradicate white-collar work in 12 to 18 months? I mean, do you just sort of take that out of the models and say, that's noise for now, and that everything that previously worked still, to some degree, is working?
So we try to parse the labor market data into what it seems to be AI-driven versus cyclical, because that is going to help to gauge what extent is going to last into the future versus what could pick up if the economy actually improves this year, which is what we think. So our sense is the unemployment rate, about half of the rising unemployment rate came from AI. So that is sticky. And then the rest appears to be cyclically driven, which is why you could see a little bit of downward pressure this year. Do we ignore it? No, but it doesn't appear like AI adoption rates are high enough such that it will really destroy labor, at least for the next 1 to 2 years.
Stephanie, good to see you. Thanks for dropping by. Stephanie Roth there, Wolfe Research, another counterpoint to the Microsoft AI chief in the Financial Times there for you. A bit of pushback once again.
Yeah, well, and I just heard 1 to 2 years. We're safe, John.
We're safe for another 24
We're safe,
months.
although I think that you kind of are interested in your poetry career. I think I would come to your recital, very much so, in the Cotswolds. I think that it would be fantastic.
I can have a great time, yeah.
Roses are red, violets are blue.
I'm hoping for something more than
This
that.
Bloomberg chart is fantastic.
For you, something like that. Let's move on very quickly. I think we can do better than that, Bramo. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. SpaceX and xAI are competing in a secret Pentagon $100 million prize contest to produce voice-controlled autonomous drone swarming technology. Well, it's already possible to fly multiple drones at once. Developing the software to direct multiple drones, which can move autonomously in pursuit of a target, remains a challenge. Meanwhile, President Trump says U.S. officials, including Secretary of State Marco Rubio, are in discussions with Cuba's government. The president told reporters that Cuba should make a deal because its economic conditions are a, quote, humanitarian threat. Cuba lost its primary subsidized oil source after the capture of Venezuelan President Nicolas Maduro. And President Trump warning the federal government won't cover any cost overruns on a $16 billion Hudson River rail tunnel project. The project, known as Gateway, would add train capacity between New Jersey and Manhattan by building a new tunnel and upgrading the existing North River tunnel. The president's offering meetings to ensure the project does not go over budget. That's your Bloomberg Brief. John.
Yahara, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead. Plus, Krishna Memani of Lafayette College joins us, breaking down the shift in market leadership. With equity futures near session lows, the S&P down by 0.4% and the Nasdaq 100 down by 0.8%. From New York City, you're watching Bloomberg Surveillance.
There's a number of people who anticipate growth. We anticipate it for longer than the market's anticipating. And that's because we haven't seen the flow through of retail spending from the tax refunds. Lower and middle income classes have a higher propensity to spend a higher amount of those tax receipts. So we do expect to see some growth surprises.
That was Earl Davis of BMO. He is bullish on the outlook and he does not think the 10-year bond yields remain around 4%. That is exactly where they are because of this. Equity futures pulling back on the S&P, negative by a few tenths of 1%. Likewise on the Nasdaq, down by 0.8, driving risk aversion and putting a bid into bonds. 10-year bond yields right now lower by around about a basis point to 4.0368%. Earlier on this morning, 4.01, very close to breaking into the threes. Going into this week, here's the trading diary for you. This is how things are set up. This is the schedule. Later on today, Fed speak from Barr and Daly. Tomorrow, the latest Fed minutes. Thursday, Walmart earnings and another round of jobless claims. Plus on Friday, core PCE and UMich sentiment and I stress possible, a possible Supreme Court decision on the president's tariffs, because we've been waiting for that one and the dates have come and gone a few times.
We once built it up all day. This is going to be it, guys, and then it didn't come out. So we're not that excited. We've been fooled, fool me once, shame on you, fool me twice, shame on me. We're kind of there.
You almost butchered that one, didn't you? Came close. I always get that one confused too.
I didn't, though.
Something
Come on, give me credit.
I don't know if you did or not now. I need to...
No, rewind it. I actually got it right.
You nailed that.
Yeah.
Okay, good. I trust you.
Yeah, thank you.
Yes, nailed it. Good. Yes. I trust you. All right.
Thanks.
Let's turn back to our top story on Wall Street. Not that. Nasdaq futures weighing on stocks as AI fears pick back up where they left off. Krishna Memani of Lafayette College writing stocks are going through their turmoil more due to sector rotation, due to valuations and run-ups than anything fundamentally different. Krishna joins us now for more. Krishna, good morning.
Morning.
Is software dead?
Well, software is not dead. I think if you you really have to define what dead means in that context. Has software come down a lot? Absolutely. Software going away as a service? Absolutely not. So the valuations and the multiples were too high, and because the terminal value is being questioned, it is appropriate to kind of take them down. And it's not that the business itself is going away or revenue is going to be zero tomorrow. It's just that the valuations that people are willing to pay are just not as fancy.
This is no longer a high multiple sector.
Exactly.
Is there a sector now that does take on that higher multiple because of the disruption we're discussing?
Well, so I think it is really going to be more about the sectors of the economy, like banking, for example, where you have substantial tailwinds, deregulation, capital relief, and things like that, where you don't have headwinds like software has from AI and all the other market narratives. So I think more fundamentally driven businesses where multiples are low probably get to a higher level, and that sort of helps the index investor.
What is this? Is this what a soft landing feels like?
Well, that's exactly the point. I mean, we have been waiting for this soft landing for 3 years, and it is arriving, and we can't just take it. If you look at inflation has been going down, it's stabilizing. Probably not. It will probably continue to go down, albeit slowly. Growth is decent. The tariff picture is it was last year's thing. It's kind of getting rolled back slowly but surely. I think things from an economic standpoint are probably as good as they have been in a long time. Along all the attributes, and we just don't like it.
If this is a soft landing, then isn't there a discrepancy between assets that are priced for reacceleration and a reality, which is something that looks very different?
Well, so I don't think assets are priced for significant reacceleration. I think because if you look at cyclicals, they aren't as kind of high multiple as they should be if we were really looking for 4 or 5% type growth. So I think those are the stabilization of the economy probably helps those types of assets. It's not that we are going into a recession that we have been awaiting for 3 years, or inflation is going to spike up that we have been talking about for a long time.
Every time we get a sell-off, we worry about how that translates into the economy. How are you thinking about that? The wealth channel, the contagion you could see from the move in financial markets through risk assets and into the real economy?
So, if you let's kind of break it down. Deficit, is it 2% or is it 5%? And how does that impact the economy? You look at where S&P is today. Is it at 4,000 or 6,000? How does that impact the economy? You look at what the inflation picture is looking like, and is the Fed going to tighten or potentially ease? Maybe not today, maybe in some future. So I think if you put all of that together, there's really no significant headwind to the economy. And, employment is good, claims are not rising, growth overall is decent with a good handle, nominal growth is pretty good. So, there's really no significant issue.
Does that keep the Federal Reserve a boring story for 2026?
Exactly. I think the Fed, we talk about the Fed as if Fed can divine the economy and kind of drive it. That's just not the case. I think Fed on a go-forward basis is probably in more of a reactive mode rather than a proactive mode, as they had been when they raised rates significantly and then cut rates significantly in anticipation of a particular outcome.
If that's the case, are you casting some shade on the rally that we're seeing right now in bonds that we have been seeing over the past couple of weeks?
Yes, I am. So the point of this would be we have been in a 4 to 4.5% trading range. And if we get close to 4%, I think thinking that it is going to 3.5%, I don't think the data would kind of get you there. And similarly, when it gets to 4.5%, thinking that it'll go to 5%, data probably doesn't get you there either. So it's a trading range, and trade the range.
So given the fact that you're chief investment fund officer for a fund for a college, you have to think longer term, and you have to think about the offsets and what the havens really look like. We've talked with people about how one haven is diversifying outside of the U.S. In years past, people would talk about private credit as sort of a ballast. How are you thinking about the offset of private credit, given the fact that some of the disruption really is happening there?
Well, so we are not an investor in private credit. We are an investor in private equity for sure. And I think, but that is part of our overall equity allocation, which is a very diversified global pool of assets, across the world. So I think what kind of the price action over the last, say, 6 months, when, if you look at international equities, what happened in Korea and things like that, I think diversification is a good thing. Whether that continues to be the trend for the next 2, 3, 5 years, because I'm not so sure, because, performance of something like Korea is really driven by an AI trade, which is really a U.S. theme rather than a Korean theme.
30% move in the Kospi. I keep going back over that. Year to date, which is just unreal. We've known you a long time. I've known you quite a while. You've got a good BS radar. I know that from private conversations as well. Can you help us understand and help the audience understand as you navigate this mass disruption? What is BS and what is real? When you see these headlines about what could and couldn't happen to software names, to the white-collar workforce, what's real?
Well, so, I would say Dario and other folks have learned a lot from Elon Musk in terms of kind of dazzling their audience. If they were them, you would expect them to say that, because they are spending trillions of dollars. And so in their mind, and therefore they expect in everyone else's mind for it to be justified. I think the reality is probably, the uptake is slow, and it happens over a decade or two rather than 12 or 18 months, half of the workforce being on the dock. I think that's just not in the context of anything that I see out there.
There's a lot of people watching right now nodding and saying, yes, Krishna, we hope you're right. Krishna Memani of Lafayette College. Krishna, thank you. Of course, there's a lot of tech people who are sitting there banging the table saying, no, Krishna, you are wrong.
Yeah.
And they've got a big valuation to justify at the same time.
Yeah, well, that's the issue. Is it a marketing ploy or is it real? Is it something that actually will cause white-collar work to get decimated in 12 to 18 months? I mean, look, this is the argument around why office space is suddenly decimated in valuation, because people think, oh, the end of the worker. Then you start to wonder, well, what's the flip side of that, the political side? Look, it's clearly somewhere in the middle. And people right now are struggling to figure it out. And it is a messy moment in markets.
Arguing to work from home at the moment is probably an uncomfortable situation to be in, though. Given this backdrop, right?
I think it's it's a situation that's happening less and less.
You think Jamie Dimon thinks he's got a bit more leverage now over at JP Morgan to make all that happen?
I think he
knows it, without a doubt. Coming up tomorrow, Keith Lerner of Truist, Jim Zelter of Apollo, Alicia Levine of BNY, Nancy Lazar of Piper Sandler from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.